afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brains. Let's make lots of money. You can tell I'm educated, I studied at the Sorbonne. Doctored in mathematics, I could have been a don. I can program a computer, choose the perfect time. If you've got the inclination, I have got the crime. There's a lot of opportunities if you know where to take them. There's a lot of opportunities if there aren't, you can make them. I've got the brains, you've got the looks. Let's make lots of money. Let's make lots of I'm single-minded, I know what I could be. How do you feel about it? Come take a walk with me. I'm looking for a partner, regardless of expense. Think about it seriously, you know it makes sense. Let's make lots of money. You've got the brawn, I've got the brains. Let's make lots of money. I've got the brains, you've got the looks. Let's make lots of money.
Let's make lots of money. The Pet Shop Boys going right into the best one yet.
Get out of here. I'm not banking with you. Not you. Not you. Nope. Nope. I'm going to be my own bank. I'm not banking with you. Uninterrupted compound interest. Start your infinite banking policy today. Bye-bye, big banks.
Bye-bye, big banks. Welcome back, everybody. Thanks for joining us for day number 2 of the infinite banking, privatized banking. And this is the advanced section where we're going to cover business uses. We've got so many business uses, like the personal uses are infinite, but the business uses are infinite times 10, or as Grant Cardone would say, we're going to 10x those business uses today. We've got a lot of stuff for you today. And before we kick off, just a couple housekeeping rules. If you have to use the restroom, please raise your hand and we will dismiss. I'm kidding. Just go to the bathroom, please. That's the beauty of these virtual events. We've got the entire team back at it today, going to be answering your questions. So if you guys have questions, just right down below, you click the Q&A, throw the questions in there. You're welcome to chat things in, but the Q&As will take precedence. And just real quick, just before we jump into Larry Lucky Jeans and a couple other things, I just want to give a quick shout out to the amazing Money Multiplier and Money School team right here. We've got Gabby up top. Give a wave, Gabby. We've got me, and then you've got Hannah down there in the left. We got Hannah Kessler and Brent Kessler as well. There we go. We've got Stephen Nagy. There we go. Give a shout out. Show everybody your shirt there. BYOB, be your own banker. So we create limited edition shirts that we give to our Money School TV or MSTV members. So you can get your BYOB. All you got to do is be a member of MSTV. We'll be talking about that, not today, but on other times. Then we've got Shauna. I don't think she's live here. We got Andrew right behind me. Okay. So you're going to see some of the work that Andrew does today with the mapping team and some of the cool things he's doing out there for each and every single one of you. Brent's sporting his BYOB hat, and there's mine, which I'm actually going with no hat today, but you got it, folks. BYOB, be your own banker is what we're talking about. And then we've got Devin, who's going to be joining us a little later, and we've got another special studio guest today, Joseph, who is also going to be joining us. I hope you guys enjoyed the intro with Pet Shop Boys. That's exactly what we're going to do. And we've got more fun things for you throughout the day. But I want to turn this over to Brent, because Brent's got an amazing presentation that we're going to kick off with today. And it's called Larry Lucky Jeans. So enjoy your day, folks.
All right, Chris, good deal. We're going to pull it up right here. So, anyway, as we talked yesterday, we went over some policy illustrations, some examples, different ways of how to use the policy. So anyway, I thought I would use this illustration here to go over how you start a policy for a brand new child and how they may use the policy throughout their lifetime. Now, as we spoke yesterday, there's so many different plan designs. There's so many different ways to create these policies. And I think we're going to go over a few of those different ways today. And we're going to show some examples. But actually, this is a 10-pay policy. Now, I will tell you, I have almost 3,000 clients in every state of the country. And I probably don't have 10 clients that are doing 10-pay policies. But every now and then, okay, somebody wants just to ask and they say, hey, I only want to fund this policy for a certain amount of time, and then I don't want to fund it anymore. I don't ever want to worry about having to fund it. Now, all right, so for most of you, as you know, the cash just continues to accumulate and grow. So year after year, and that's why I always say you never, ever, ever, ever want to stop paying your premium in a whole life policy in a mutual company that pays dividends because of the growth of the policy. And I'll just kind of throw you back to the example of the money multiplier map. If you remember in that mapping example on my presentation, the guy was putting in $25,000 a year, right? And he was putting it in for the first 5 years. And then after that, he dropped it down to $10,000, right? Because of the way that was structured, the base premium and the PUA premium. So on that map example, you basically got 40% going into base premium, and you got 60% going into the paid up additions. So on that $25,000 mapping example on my presentation, we have 10,000 going into the base and 15,000 going into the paid up additions rider. Well, if you remember, at the end of the 5th year, or the beginning of the 6th year on that policy, what we did is we dropped off that paid up additions rider portion. So now we're only paying $10,000, or basically 40% of the $25,000. And if you remember how much money that he could use, okay, so like immediately. So when he put in that $10,000, he was immediately able to use $13,000. Now that is a 30% increase on his money that he had access to that year. Well, guess what's going to happen in the next year? In year 6, 7, 8, 9, 10, those numbers are only going to continue to get bigger. So why would you ever want to stop that process, right? So in other words, in that example, it would be like saying every time you gave me a $10 bill, I gave you $13 back. Right? So would you ever want to stop that? Every time you gave me $100, I gave you $130. Every time you gave me 1,000, I gave you 1,300. 10,000, I gave you 13,000. You would never, ever want to stop that process. So that's why we teach you never, ever, ever want to stop funding these policies because of that enormous cash value growth. And remember what we said yesterday. Every day is better than the day before. Today's better than yesterday, and tomorrow is better than today. Now, that's not me telling you that, Chris telling you, Andrew, Stephen, Gabby. No, that is in your policy contract. That being said, even though even though all of us talked or were blue in the face on that point, you still have people sometimes that want to only pay a certain amount of time. So this example is a 10 pay policy. Now, as you notice, okay, this is a company we write with, Ohio National. And okay, guys, look, it doesn't matter what the company it is. It's all in the design of the policy. It's if that company allows you to design your policy this way. All right. So does that mean we couldn't do this with one of our other companies like Lafayette Life, like One America? No, absolutely not. Right. But this is an actual example. And okay, we call it Larry Lucky Jeans. Okay, Larry Lucky Jeans is the name of this policy. And if you see, it's a male, age 1, if you see up there at the top right, all right, and it tells you, okay, so now if you come down here to the policy, it tells you the age of the person on the left. It tells you the year. All that is time, year 1 to 5, 6 to 10, 11 to 15, etc. Okay. It also tells you the premium that you're putting into the policy, right? I've got that highlighted there, $15,000 a year. And what we're going to do, since this is a 10-year, okay, and since this is a 10 pay policy, guess how long we're going to fund it for? That's right, 10 years. So in this particular example, we're going to put in $15,000 a year for 10 years. So the next column over, it tells you your cumulative premium paid in cash. So for example, in year 1, 15, year 2, 30, year 3, 45. So that's the total amount of premium that you've put in it, that you have injected up until that date. And it has the cash value. Now look, if you notice how, okay, the cash value on this policy is very low, right? The thing you do is you put in 15 grand and immediately you've only got $754 to use in the policy. Totally different than the plan designs that you've seen us present. All right. But again, this is a different product. And then let's see, all the way on the right hand column is your death benefit, right? So that's the initial death benefit on this age of child that's 1 year old. So in this example, $15,000 of premium buys them over $1.6 million of death benefit. Okay. And then anyway, this column here, the tax equivalent rate of return. So I really don't want you to pay attention to that. But I mean, if you really want to get into the details and the numbers, you can. And at the end of this, okay, so you'll kind of see what has happened inside of this policy. Because remember, the thing that we've talked about is the policies have a guaranteed rate of return of 4%. All right. That's the guaranteed rate. That's not us telling you, that's in the policy contract. So you'll see that as we go down. All right. So if you notice, I want you just to look at the first 10 years of the policy. And if you notice, he put in $15,000 a year for 10 years. So his cumulative premium that he's paid in is $150,000. Now, keep in mind, okay, the cash value is the amount that he can borrow. Okay, so like each year, right? So each year he can borrow this amount. So for example, in the first year, he could borrow $754 out. And if he didn't borrow the $754 out in year 1, then in year 2, he would be able to use $1,696. In year 3, he would be able to use $17,398. Okay. But if you take any of the cash out prior, it's just going to decrease the amount, right? So for example, let's just say that he borrowed, in this case here, he borrowed all $35,640 out in year 4. So the next year, okay, it's going to be the difference of this number that he can borrow, the 35 and the 54. So that's about $19,000 that he would be able to use. Are you with me?
Hey, Brent, a bunch of people are saying the screen is blurry. I'm not sure if maybe just when you move it, it has to, resume in on it. Hopefully it's just a temporary thing.
I'm not sure. It's crystal clear. Hannah, do you know?
Yeah, mine looks good too.
I have it here on
It's crystal clear on my end. Is there anything I can, like buttons I can push or?
Let me put it into Google.
Yeah, because everybody's saying it's blurry.
I'll
Okay.
link the Google Drive.
Okay, hold on. Stand by just a minute. Hannah's gonna try to fix it. So in the meantime, so that Hannah is doing that, okay, so, okay, like in this particular policy, so basically he's not using any of the cash value. He's basically just putting the money inside of the policy and he's putting it on the shelf. So he's not using it. And of course, that's what we teach, right? The thing we teach you is to use the policy, keep the money in motion. So it would be just like the worst thing that you could do would be just to buy the policy, put it on the shelf and not use the cash value. Because as long as you have products and services that you're buying anyway, or you're doing investments, you always want to keep the money moving and you want to keep that money in motion. But as you're going to see, okay, as we go through this example, even if you just bought the policy and you put it on the shelf for a while, it's still going to be a great thing. All we're saying is that the more you use it, the bigger the numbers are actually going to get. So, all right, I think Hannah has this. Is it complete?
Yeah, I just gotta share. Hold on, give me a second.
Okay.
Yeah, I got a black screen here.
Yeah, hold on.
have
She's
to
pulling it up.
Share and then reshare.
I don't know what she's doing, man, but she's typing all this stuff in and moving this mouse and doing that. I'd be lost without Hannah.
I feel the same way with Shauna and Andrew.
Absolutely. I feel the same way about Sean and Andrew and Gabby and Steven and all of the above. Absolutely. Is that better?
No, hold on. I'm gonna link it.
Oh, hang on.
If it's still blurry, I'm gonna.
Yeah, it is still blurry.
Hold on.
It might be an internet thing.
We're gonna link this to people.
Well,
Some people are saying it's good on a tablet, but not an iPad. So it might depend on what they're watching on.
oh yeah, that's true. Because I know sometimes on a cell phone, man, this stuff doesn't work the same. I know that for sure. So if you're watching it on a tablet, that might be the issue. Chris, the only thing is that I could send this to you and you can
Nope.
put it up
All right,
on yours.
So it's in the Google Drive.
Okay. So now what do we do?
All right, I just.
Okay, hold on.
Ooh, good morning. All right, I just linked this example in the Google Drive. So go click the link in that Google Drive and then follow along with Brent, okay?
Oh, I see what you mean.
that's how I want to do it.
Yeah, they just go into the chat and click that, and then that'll give them the ability to see the same thing Brent's using. And then for anyone that doesn't have a blurry version, you can just continue to watch. All right, perfect. Problem solved. Tech.
All right, is that good? Okay.
I'll send a letter to Apple telling them that they need to upgrade their systems because obviously that's where the problem is.
Well, actually, Hannah uses an Apple, but I use a Microsoft Surface.
Yeah, no, that was just a jab. That's all.
No, I know. I'm just saying. I'm just saying. Anyway, so like we get in these arguments all the time. Hannah and I do. Hannah tells me Apple is better than the Microsoft Surface, but then I have to go to my wife and I say, "Hey, honey, Hannah says Apple is better," and then my wife says, "Well, I'm not working on an Apple computer, so if you want me to fix your computer when it's broken, then you better stick with the Microsoft. If not, have Hannah fix it." So I'm going to stick with the Microsoft Surface.
All right.
That's my reasoning anyway. I don't know, whatever. It's kind of like right. So like, it's kind of like, like, and of course, okay. So like all of you guys that know me know that I hate technology and I suck at technology. And just if I'm ever having a problem with my iPhone, I take it to my wife and I say, "Honey, so my phone's not working. What is going on?" And the thing she does is she turns it over and she says, "That's your problem." And I says, "What's that?" And she points to the Apple. She says, "That's why it's not working, because it's an Apple." Anyway, just a little humor there. All right. So in this example, the thing we're going to do is 10 years and we're going to put in a year for a total of 150,000. So if you notice in the 10th year, they have cash value of 164,000. You can scroll all the way over to the right on the death benefit in year 10, and it's 1.8 million. All right. So this policy was started for a newborn. It's probably a policy a parent or a grandparent started for that child. So now, if you scroll down to year 18, okay, age 18 years old, now the child is going to go to college. And in this case, this policy is going to be used to fund college. So assuming that college is going to be $20,000 a year, they're going to start using the cash value, which they have $221,000 here to be able to use. And so, okay, so the thing they're going to do is they're going to put in $20,000 a year to pay for the college for 4 years. So if you notice this column over here, let me scroll back up so you can see it, but it's the cumulative cash flow received. So in college, okay, 20,000 in year 1, 20,000 in year 2 for a total of 40. Then in year 3, 60, and year 4, another 20 for a total of 80. So the thing we just did is we paid for college education at $20,000 a year for 4 years of college education. Now, keep in mind, all we're going to do is take money out of this policy. We're not paying it back. We're not paying the loans back in this example, okay? And again, I know that's not what we really teach, but I want you to see how you don't have to pay back the policy loans, and it's going to work. All right. So now that child's went to college. They spent 4 years going to college, and that's paid for. And now we get down to what you did, age 25. Age 25, and now they're going to get married. Okay, that's okay. That child is going to get married. So now we've got $30,000 to pay for the wedding. So how much have we taken out of the policy in a cumulative total? 80 plus 30 is a total of $110,000. So they get married, and a couple years later, they want to buy a house. They're tired of renting, I guess. So now they're going to come up with a down payment of the house. What is the down payment of the house going to be? $40,000. Now, I want you to notice here in, all right, just in year 30, they have $251,000 in the policy. So again, there's all this money that they're not even touching in the policy, right? So all we're doing is going through and showing you an example of what somebody may do. I mean, who knows? All right. Instead of putting the 40,000 down on the house, maybe they want to just go buy the house cash because they have 250 grand. They could do it. Remember, this is the infinite banking concept. These strategies are infinite. There's so many different designs and things that you can do. But in this case, he's going to take 40,000 from the policy, and he's going to put the down payment of the house of 40 grand. So now if you notice, I haven't highlighted, he's taken out $150,000 out of this policy so far. Up to this point, that's what he's taken out. Well, how much has he put in? He put in 15 a year for 10 years, a total of 150, right? So he's gotten everything out of the policy that he put in, but anyway, life is going to go on. He still has his cash value. He still has his death benefit. He has this growth rate of what's going on in the policy. So we continue to truck down that avenue we call life. Okay. And we get to, let's go to the next page. Now he's 47 years old. Okay. He has his own children at age 47, because how old was he when he got married? 25. So 20 years later, 22 years later, okay, he's got his own children that are now ready for college. Well, in this example, it showed you that college has increased, not 20,000 a year when he was going. Now it's 30,000 a year. And he has 2 children, and they're 2 years apart. So he starts college for the first child. Let's just call them age 18. And if you notice, he pays the $30,000 a year for the first child. and he pays all right, he pays that for the first year, which is 30,000, and he pays it for the second year, which is 30,000. But then the child that's 2 years younger than him or her now is ready for college. So now he's got to pay $60,000 a year in tuition. So it's 30,000 times 2 for college for both of the children. So each kid is going to go to college for a total of 4 years, but for 2 of those years, he's going to have to pay double, right? He's going to have to pay double, 60,000 in premium, because they're in college at the same time. So now, if you notice in year 51 and 52, the first kid has graduated from college or is done with the 4 years, but he still owes for the second child the last 2 years. So that's why you see 30 and 30. So if you add all of those numbers up, each kid went to college for 4 years at $30,000 a year, which is $120,000 for each child, times 2 is 240. So if you add these numbers up right here, okay, you add 30 plus 30, 60 plus 60 plus 30 plus 30, that's $240,000. So this policy paid for the college for those 2 children, or 4 years each. And if you notice, he's taken out up to this point in year 52, or actually age 52, year 51, he's taken out $390,000 from this policy so far. Just to recap, just where we're at now. How did he take the money out? Well, he actually took out for himself, and he put down $80,000 in college for himself. Then he got married for another $30,000. Then he did a down payment for $40,000 on a house, and he put 2 kids through college at $120,000 apiece for a total of $240,000. So all of those numbers equal $390,000. Keep in mind, he has not paid anything back to this policy. He's only using the money. And he has not paid any outside injection into this premium, in since year 10. He put in $15,000 a year for 10 years, a total of $150,000. All right. So now he keeps trucking down the road of life. And now all of a sudden he gets to age 65. He gets to age 65. Well, how much does he have at age 65 in the cash value, right? It's like 1.1 million. 1.1 million. Okay. So he's ready to retire. So he's now going to start taking out retirement income of $60,000 a year. Why did he choose 60,000, or where did that number come from? Just like Chris and I talked about a couple times yesterday, you pull it out of the air, man. You decide the number you want to use. He has $1 million. He has 1.1 million in the policy that he could use or take out if he wanted to, because that's his cash value, right? So he chooses to take out $60,000 a year at age 65. And if you notice, these cumulative numbers go up, right? Because it goes from 390 to 450 to 510 to 570 to 630. So each year, the cumulative number that he's taken out of the policy it continues to go up, because he's taken out 60,000 a year. So this is the amount that he has taken out of this policy up until these given dates. All right. So he, at age 65, he retires. He takes 60,000 a year out all the way until he gets to age 90. Okay. And I'm assuming, they're going to kill him off here at age 90. And he's taken out all that retirement income for, what was it, 25 years, I think, 60,000 a year. Well, how much has he taken out of the policy total? He's taken out 1.89 million, almost $1.9 million he's taken out over the life of the policy, which is 90 years. I want you to look at the numbers I have highlighted in yellow. All right, let's just recap. Look, $150,000 is the cumulative amount of premium that he's paid in, okay, That's what he's paid into the policy. And he did that all in the first 10 years. He has a cash value of $1,093,000 that is still in the policy. That money is still in the policy, and he's taken out a total of almost 1.9 million. It tells you what his rate of return was over the policy, and it tells you what the death benefit is that he's going to leave to the next generation. All right. So let's kind of put it all together. At the child's age of 90, on a total of $150,000 in premium paid, they have withdrawn almost $1.9 million, which is a 7.94% taxable equivalent rate of return. Plus, they still have $1,093,000 in cash value and a $2,400,000 in death benefit. Truly the gift of a lifetime. So now do you see why we say there is no better gift than a parent or a grandparent can get for a child or a grandchild than a whole life policy in a mutual company that pays dividends? And this example that I just showed you, ladies and gentlemen, boys and girls, I don't even think this is a great example. I mean, I just don't think I think it's weak because he stopped paying the premium after the first 10 years. Could you imagine what these numbers would look like if you continued to pay the premium on this policy, and if you used all the cash value that was there for the things that you're buying in life anyway, your debts, your expenses, your investments, your business purchases, whatever it was? Could you imagine if you were using all of the money and you kept all of that money in motion and you played honest banker with yourself and you continued to pay yourself back with interest the same way? It's the same way you pay a bank back when you borrow money from them. In this example, all we did is we funded this thing for 10 years. That's it. And then we sucked money out of it. We never put any money back. So anyway, just another example of how powerful this tool is. And again, as I said yesterday, I've known about this concept since 2006, all right, for 15 years. And even though 15 years ago, I learned about this banking concept, it took me 2 years to get started, right? So I've only had my oldest policy has only been in effect for 13 years, even though I've known about it for 15 years, because the first 2 years, I thought it was too good to be true. I thought it was a con job. I said, there's no way this thing could work. Because see, I saw this presentation. I saw this presentation in 2006, but I thought it was too good to be true. Somebody's lying to me. So I was actually at a chiropractic conference when I heard this information. I saw it. I looked at it in 2006. I had this book here. Here, Hannah, hand me that book. Anyway, here, I got it right here. Okay. So anyway, this book, Becoming Your Own Banker by R. Nelson Nash. I took this book home. I put it on my shelf. I put it away. I didn't do anything with it. All right. It just sat there. I go back to another chiropractic convention about a year and a half later, almost 2 years later, and about 10 or 12 of my colleagues that were at that previous convention with me were now at this one. And they were coming up to me and they were ranting and raving and they were saying, man, isn't that banking concept the most awesome thing ever to pay off debt, recapture money, build wealth, all without working harder, changing your cash flow, taking any additional risk or losing control. All we're doing is adding one extra step. So after I heard that from 10 or 12 of my colleagues, they were throwing up all over me about how this was working in their life. I said, there's got to be something to this, right? So I came home and I told my wife, I said, honey, we're going to start this policy in our life because I don't even know everything about it, but I know that 10 or 12 of my colleagues are not lying to me. Maybe 1 or 2 were lying, but not 10 or 12. And I started my own banking policy in February of 2008. And in 3 years and 3 months, 39 months, I was able to pay off $984,711 of third-party debt without working harder, changing my cash flow, taking any additional risk or losing control. Just adding one step in my financial life. And that one step is what? Buying this stupid ass whole life insurance policy in a mutual company that pays dividends. That's it. We're not asking you to change anything you're currently doing. Just add one step in your life. So like, remember the call we did yesterday? I said, all right. So anyway, I said, it's kind of like if you get in a car and you drive to the grocery store. On the way to the grocery store, you stop at the gas station to fill up. That's it. The thing you're doing is you're still heading to the grocery store. You're just going to make one extra step, one extra stop, and you're going to stop and you're going to fill up with gas. Well, the thing you're going to do is you're going to stop and you're going to fill up your own banking system with your own cash and start building that wealth for your own family instead of letting all that money leak out to other people. Okay, Chris, throw it back to you, brother.
Yeah, that was great. I love that life cycle. I mean, we did this yesterday with my one policy, and I got my policy was started, that you saw yesterday where we were doing that. It was started in the 40s, right? This is a policy just like I did for Vivi, started early on. So I'd love to do something like this with Vivi's plan, because I'll tell you, Vivi's plan is I'm never going to stop putting money into it, and she better never stop putting into it, because even if I'm in the grave, I'm going to remind her why she's putting that money in. So it's just, it's just such an awesome thing to see when you see that. And the interesting parts about that is there was, we don't even teach people to use them like this, where you just take money out and you don't recapture any of it. But this one showed no recapture at all. It just showed just use the policy and abuse it, I guess, steal the peas, right? You walk into your grocery store, you grab the peas, you walk them out the back door, and you never put the money back in. That's stealing the peas. But it still worked like that, which is just so incredible. What would it look like if you didn't steal the peas? If you were an honest banker, I bet you these numbers would be doubled. I bet your segregated account would have another $1 million in it.
Yeah, absolutely, Chris. I mean, it is. It's just, and again, these contracts can be set up in all kind of different ways. It's however the client wants them set up. But as we teach to continue to fund those policies and keep them going, because the numbers only get bigger. So, yeah, I mean, I'm telling you, I don't think, all right. So like ever since Hannah has been with me, which has been a few years now, I don't think she's ever seen me do a 10-pay policy on anybody. Have you? Have you ever seen me do one? No. We just don't do them. But even the 10 pays aren't bad. But the thing is, every now and then you get somebody that they get stuck in their head that they want to stop paying that premium, right? They want to stop. They want it to end. So this may be for some of those.
Also, though, so what I tell people who want 10-pay policies is that the whole life policies have you can change it to the contract status called reduced paid up after the 10th year. So if you want to, you can always stop paying your premiums by just changing that contract status, and it'll keep going on just like this one. However, it'd be kind of crappy if you got the 10-pay policy, then year 11 rolls around, you're like, oh my gosh, this thing is so cool, I want to put more premium into it. And I got to tell you, well, tough luck, because 10 years ago you said you didn't want to keep paying your premium. Okay.
Yeah, so that's an important thing, Chris. If a person sets up a 10-pay and they're like, man, this is working good, I don't want to stop paying it, you can't just continue to pay for it, because the contract only is allowing you to pay it for that time. So it's way better to go the other route, to continue to put dollars in the premium. And then if you want to stop it, you could. Yes. Does that make sense? So,
Brent, as I was a high-level financial advisor for 16 years, and we sold a ton of 10-pays. They were called CWLs, custom whole life. And we would always try to figure out what's the least amount of time we can put money into these plans. And we always did that because, remember, we were the old way of thinking. We had the rosy colored glasses on, premium bad, premium expense, premium bad. Even though these were whole lives and they had cash value, I was brainwashed to believe that the least amount of time that I put premium in was the best. And it was it's almost the complete opposite of what it really was. And we say that all the time, everything you've learned your whole life about money, this is the complete opposite. The wealthy do the complete opposite of what we've been taught. And as an advisor, I mean, you would think I would have been taught differently, and I wasn't. We were always taught push money, into investments. And, if you really understand investments, I'm not saying anything bad about the stock market. Matter of fact, we're going to cover stock market today, but I just think that, there's so much money to be made by advisors and advisory firms on the investment vehicles that it's sometimes skewed them talking about, or even me talking about these whole lives. And I didn't know anything about infinite banking. I didn't know how to build a policy this way. If someone came to me and said, hey, this guy showed me a whole life policy where I put 50 grand into the plan and I'm able to use 60 to 90%, I would have been like, ha, yeah, right. He's lying to you, man. He's lying to you. That's what I would have said. And I forgot, when Mike Baird at that Cheesecake Factory in Salt Lake City told me about this, I'm like, no, someone's lying to you. So which would have been you, because he's originally told me, said, this guy Brent, did this. I'm like, there's no way it works that way. And that's when I have ended up calling you and begging you to teach me this. And you said, watch the 90-minute video. And I was like, damn it. And I watched the 90-minute video. And the next thing I think I remember, when I opened my eyes, I was in Mexico with Larissa, learning all about it. So that was my story, and that's how I did it. But, it really is one of those things where people just aren't taught this. Advisors aren't trained on this, and probably never will be, because when I asked my managing partner, I took him out for lunch, and I said to him, how come you never taught me and the other reps about this infinite banking policy? His name was John. And John looks over and he says, oh, we know all about it. Bully, it's what we do for the banks. We have a whole division for it. Well, one of the reasons we don't, as you know, that, the most of the money going into the PUA, the advisor wouldn't get paid. So that would be like the advisor taking a 60 to 90% pay cut. I said, yeah, exactly. That 60 to 90% goes to the client instead of just to us. Like, that's the point. And he's like, yeah, but you remember how hard it is for me to keep agents going, because it's commission only. And even if I can keep an agent for 5 years, that's a monumental victory for me, because then I got a chance of keeping them for a very long time. But what if then I had to go back to all these agents, teach them about this infinite banking process, and then get them super excited about what it does and how the numbers look and how they can use it. And then all of a sudden I got to be the guy at the front that says, oh, and by the way, you have to give up 60 to 90% of your commission. How many people? And then he looks at me, he says, how many people do you think I'd have left in this GO? And I looked at John, I said, lunch is on me, buddy. And that was the answer I was looking for. Like, why wasn't I taught this? There you go, folks. That was why. And, one other thing too, that I wanted to do, now that we just saw the Larry Lucky Jeans, and that's probably one of my, every time you say Larry Lucky Jeans, I got a terrible memory. My mind never goes to that example. And then when you present it, I'm like, oh, this is one of my favorites. So let me share my screen here real quick. And what we're going to do, and folks, a lot of you, are looking at this, you already have policies, you're already doing this, and we constantly on a monthly basis are doing case studies with real clients. You're going to hear from two of them today, Devin and Joseph. But this example on the screen, this is really where our team, the money multiplier team, why do people use the money multiplier? This is one big reason. We have a mapping team that is there to serve you, to make sure that your goals are fulfilled, to make sure that your plan is put to work to solve those money problems. And this example that you're looking on the screen, I know there's a lot of numbers there. This is case study number 1 that we did. His name was Chris Kiersch. You should go to my YouTube channel at the Chris Naugle and really watch this. It's a 3-part series, but we always hear people when we get them on the phone or on the Facebook group talking about that 1090 thing, well, why wouldn't you design it with 1090? All the gurus are saying 1090 is the best. It's the silver bullet. And, I got to tell you, Andrew in my office is sort of I don't know what the word would be. He's never just okay, that's the best plan. Let's do that. He's like, let me prove that. So he went through, and this is Chris Kiersch's plan. You guys can see this in the video. And he literally took all the different designs. We went to the insurance company and we said, hey, we want to see that 60-40 design that Nelson Nash talks about in his book. Oh, and then not only that, we want to, let's get a little, exotic, and let's do a 70-30 design. And then let's do that HECV plan, that high early cash value plan that you've heard me talk about. And then let's do, we couldn't get a full 90-10 on this one, a 10-90, 10% base. So we did an 85-15, and we literally ran the numbers, 5-year intervals, and we ran them down. And look, you know, just like you just saw with Larry Lucky Jeans, like Brent said, that wouldn't be the best plan. We probably wouldn't use that plan if we were going to help somebody try to do that life cycle, because why would you ever want to stop putting money in? Well, the other thing too, we often don't use this plan design unless there's an extreme need for that. And I'm going to talk about that in a second. You know, we will typically not use this because we're hurting you in the long run. Mathematically, right there, proven. But then let's go down and let's look at cash on cash return. How much of your money each year from a percentage standpoint can you actually use? How much are you making on your dollars each year? I just want you to look at these, right? These are just, these bottom ones are just cash on cash. And I'm not trying to, and believe me, I also want to point out with Mass Mutual, I want to show you why that carrier, we're not really using them much anymore. They're a great company, great insurance company, but I'm going to show you another one in a second that basically should open your eyes in a huge way. Hannah has cracked the code. I showed it yesterday, but today we're going to dive in a little deeper. But here you go, cash on cash 70-30, worst one. That was by far the worst option. The HECV worked great from a cash on cash in the first 5 years, but then after that, wow, significantly underperformed. And what the hell happened here later in life? Like, look at these returns. This is the boring old Nelson Nash 60-40 that we use all the time. Even though this is a 60-40, this plan, how it works is it gives you a lot up front, but it peels back dividends later. So you receive less dividend crediting later. And, you know, sometimes it's hard to differentiate that. So we just did it mathematically. Not that this is a bad plan, but you would have been better off over here from a cash on cash. And the 90-10 or the 85-15 being exact. Look this. Only 1 year did it have a better cash on cash return. So the reason I show this is not to get nerding out in the numbers, but a lot of people, when we're talking to them, when we're doing trainings, I know on the Wealth Webinar Series, which is a free training we do every single Wednesday at 1 p.m. Eastern time, when we get into this, everybody nerds out on the numbers. At this point, day number 2, if you can't see that this isn't just about the policy, it's about the process, then we have somewhere failed to teach you that this process is what's important. The policy, sure, it's a machine, it moves money and it does it pretty efficiently. And there's a couple different designs, as you can see, but without you using the process of taking back the banking functions, this is just a glorified savings account. This is just a glorified, you know, account that you put your money in. That's all this is. And that's not the point. The point really for each and every one of you should be taking back the money you're giving away, taking back the financing aspects in your life instead of giving them up to somebody else so that somebody else is in control of your money. That's what we're trying to show with this. And then this, we just did this yesterday. Literally, Andrew, after we got done with the training yesterday, we knew we were talking business and we wanted to talk about this plan, which we have deemed it in the office to be called the Slayer. This is a Lafayette Life plan design. And this is a plan where the gentleman's putting 120 in and then 20,000 up here, almost to year 10. When we drop, somebody asked yesterday about that, you know, remember that death benefit drop right here? Why would your death benefit go down by 3 million? 7-year term drops off. We get rid of that rudder that's on the very nose of my rocket ship that's trying to go fast. We got to get rid of that thing because it's cost. It's an absolute cost. Well, going back to the 1090, one of the things that I've never loved about the 1090 is you can't really get rid of the cost because you'll have only 10% in the base, which is your main booster rocket. You got 90% going into PUAs, which require a term rider. So if you want to keep putting money into the plan, well, you got to keep the term on, and there's a cost, a direct 100% cost for you for that term rider. So we get rid of it. And then, you know, here, this is a tool that Andrew builds or our mapping team builds for you called the Cashflow tool. It will show you each year how much money you have to use. Puts in 20, gets 20,008. Down here in 10, puts in 18,519, gets 30. Then down here, year 15, puts in 7, gets 25. We do this to show you each year what your usable money is. Why? Because the process requires money to move, doesn't it? So if money is to be moving, The most important number on all this jumble of numbers is none other than how much money can I move that year, which is right here. How much money can I move each year is one of the most important numbers that we use for the infinite banking concept, because it allows you to take this money and go out and make more money with it. I saw somebody earlier in one of the chats mention, well, can I take money from the policy and then, start a second policy with that? In other words, could I take this 20 grand, move it out and start policy number 2? You sure can, but you definitely want to look at that and you want to say, is there a better use of that 20 grand than starting a second policy? Are you maximizing the first policy in the best manner? So I'm not saying that's a bad concept, but we would just want to flush that out. Now, let me go one step further here, because this, I think you guys are going to really like. This plan right here, Andrew in mapping for all of our members, and also just so everybody understands what the mapping team does, the mapping team works with you the moment your policy goes in force. In other words, when you make your first deposit into your plan that was approved, at that point, that's when you're introduced to the mapping team. Before that point, you do not get access to the mapping team. The mapping team spends hours and hours designing these different plans and your maps like you've seen. So we hold that as a right for our members only. Okay, that is not something that we just offer to the public. That is not something anyone will ever have access to until they become a member and get their butt in the driver's seat of their fancy dancy new privatized banking policy. When that sucker's started and ready to go, we'll put Andrew or Jonah or one of our mapping specialists in the passenger seat, and they're going to be your GPS. They're going to tell you how fast to go in the corner, how low or high to go in that corner, hit the accelerators, damn it, we got a lot of catching up to do, and when to hit the brakes. They're also going to tell you make a left, make a right. They're going to get you there. Okay, that's what their job is to do. And these are the tools that they create. And this is another really cool tool that they create for you. And this one, again, is that Slayer plan I just showed. You can see here, this is the cash on cash return broken down to you basically get out of your money that you deposited. That shouldn't be investment there, but it's, if you're comparing this to your investments and you're comparing your deposits here to what you would make in Wall Street investments, so to say, number one, you probably shouldn't be, but you could do that right here. Each year, look at your investments. Did they make this much? Were you able to take the money out of your mutual funds or ETFs and go use it to buy an investment property, use it to loan money to a real estate investor, use it to loan money to your company to fund your marketing? Are you allowed to take the money out and then still get paid these returns, even though you took the money out of your mutual fund account? That's silly. As Bugs Bunny would say, silly rabbit. Is that Bugs Bunny that says that? Silly rabbit? I think so.
Yes.
Okay. At least I got it right.
No. Wait a minute. That's Elmer Fudd that says
that's
that.
Right. Elmer Fudd saying that's a Bugs Bunny. There we go. See, just making sure you're all paying attention here, folks. Just making sure you're all paying attention. That's a nice pivot right there. I'll have to use that more next time. So you can all see, here's your cash on cash return on that Slayer plan. And, a lot of people, like I said yesterday, they look at this, they're like, oh, that must be one of those fancy 1090 plans. Nope, absolutely not. Matter of fact, this sucker's a 3565. That's right. 3565, 65 going to those fancy paid up editions. And if you don't understand what I mean by this stuff, good. I actually commend you if you don't know or don't care about this 65-35, 10-90, 70-30. That means you actually understand what you do because you're focused on the process. If you're so caught up in these plan designs, that means we got a little bit of work to do to get you to start understanding why you do this, not what is doing this and how it's doing that. But, I got to try to cover it for everybody because I wanted you to see this. But this is what our team will do. And we also do it guaranteed and non-guaranteed. And one thing I'll tell you, I probably shouldn't call insurance companies into this, but there's a company called AUL, okay, American United Life. One America is another name if you look them up. We use this company a lot. My favorite policy is a One America policy. I literally had to fly to Florida to get my medical test because One America doesn't write insurance in New York, this crappy state I live in. So I flew to Florida and got my medical test. I even rented a house in Florida to say I had a residence there, not to get this. I was actually moving, but anyway, that makes for a better story. Yeah, I rented a house just to get a One America policy. that would be crazy. But One America has one of the highest guaranteed rates that we have seen. And One America, we ran a study recently where we compared One America with another plan that, when you illustrate, the other plan looked like it had a lot more cash value. But when you actually put them in a graph and you took loans out each year, like Larry Lucky Jeans, the One America plan kicked the crap out of the other one. So it's interesting, don't always get caught up in the numbers, get caught up in the process. That is single-handedly one of the most important things. But I just wanted to give you guys a sample of the different things that we do on the back end for our members so that our members have, think of it this way, like, you're getting into banking here. We're teaching you how to become your own banker, BYOB. In becoming your own banker, one important thing is you better have a back office tracking this stuff. Could you imagine if your bank only had the people that issued the loans and there was no one in the back tracking the loan payments, the interest rates, the payments coming in and going out and when loans were paid off? That bank would be a mess. Well, your bank would be a mess as well, which is why Brent was smart enough to realize that if we're going to get into the banking business and help people understand how to take back the banking functions, well, darn it, man, we got to create a banking back office for our members because, they're busy working their business. They're busy out there doing the things they do on a day in and day out basis. They don't have time to do all this back office tracking. I mean, if all of you have time to sit down and do a spreadsheet like this, well, that's fine, but we just do it for you. These are the things that we do for our members that makes us incredibly unique. And our member, just so everybody understands what members means, it doesn't mean that you wrote a check to Brent, me, Hannah, or the Money Multiplier. It means that you are our client. We just don't call our clients clients. We call them members. And we don't call our agents agents. We call them your money multiplier or your money mentor, because our job is to solve your money problem. And that's what a money mentor does. So with that, I'm going to bring us to go ahead.
So can I just expand on a couple of things that you said? That was really, really good, by the way. And there's probably some people on the call that don't have any clue of what the map is, the money multiplier map, what that tool is. So anyway, the thing I just want to do is I just want to offer, just to everyone out there that has not seen the map, all you got to do is email me, Brent, B-R-E-N-T, Brent at themoneymultiplier.com. And if you want, I will send you my full recorded presentation. And it also has the map on there. It also has the downloadable map. Okay. And anyway, all the other attachments that go along with it. And that way, as you watch the presentation, the map will make more sense to you if you haven't seen it before. But so anyway, the map is created after you put your policy in force, because the tool that is used to create the map is that in-force policy, the in-force policy illustration. So your mapping specialist, and we have a few mapping specialists on our team. And anyway, so you've seen Andrew today. So Andrew is one of our mapping specialists. So whoever the mapping specialist that is assigned to you, they're going to create your own map. And the thing they're going to do is take all of your numbers, the amount of premium that you're putting into it, and they're going to take the debts and the expenses that are going to go into the map. Whatever information you give them, the more information, the better. And they are going to create that map for you. Now, that is generally done within about 72 hours after you start your policy. That's when the mapping designs is after you start the policy. Now, so now on the map, it is very magical. I say the mapping is magical, but again, so there's not a lot of magic inside of the map. It is simply an Excel spreadsheet that is designed for you, right? And it's just taking the numbers of the illustration and they're applying it to your own personal situation. So like any of you could create okay, the map on your own, right? But again, just like Chris said, you're busy. You don't want to manage that stuff. You want somebody else to create it for you. And that's what we do as your servicing agent. Okay. That's what we do as your servicing agent is we provide those tools, all those tools for you. So not only do we create the map, we also create your cash flow analysis. Not only do we create you one map, we update that map a few times a year, about every 4 months, because wherever you're at today in your financial life is not where you were 1, 5, and 10 years ago. And it's not going to be where you're at 1, 5, and 10 years from now, because in your financial life, the thing that you're going to do is you're going to buy things and sell things. You're going to have windfalls and downfalls. You're going to have raises and demotions. So the map is a moving target. It's always changing because you're doing all kind of stuff with your financial life all the time. So it's constantly changing, and we are going to do that for you. All right. And as Chris said, there's never a dime that's going to be paid to me or Chris Naugle or Gabby, Hannah, Steven, Andrew to do the map. Okay, we do that because you are our members, you are our clients. That is part of our servicing that we give to you, right? That is part of our service to you. We process all of your policy loans. Right? So like all the stuff that you do in your policy, our team does that for you. Now, yes, if you want to call the insurance company directly, and if like you want to get the information on your policy, you can. Absolutely, you can. It's your policy. All right, you are in control, but you might as well let us just to help and just to serve you better. It's part of the service that we provide for you because you guys are busy. So let us put all of that together. So I just want to be clear on the map. The map gets done after you put your policy in force. Now, I want to be totally transparent here. There are some clients that say, Brent, Chris, I am not starting that damn policy until you design the map for me. I'm not doing it. I'm not going to fund the policy until you start the map. Well, probably we're going to say, okay, well, maybe then you're not going to start the policy because we're not going to change our rules and the way we play the game just because you're like jiping and yiping and screaming and yelling, right? But however, I want to tell you that there is an out. Okay. So like, let's say if you really, really feel that way. All right. So anytime you put a policy in force, all the insurance companies give you at least a free 10-day look period, even longer. Some companies, I think, even give you 30 days to cancel and rescind and take your policy back. So the worst case scenario, all right, the worst case scenario. So let's say that you start the policy. You actually pay your first months of premium or your first year of premium. So you've sent in your premium. Now, within that first 72 hours, the map gets done for you. All right. So even if it took a week, let's just say it takes a week and it's not in 72 hours. And then after we have created the map, your cash flow analysis, all of those policy tools for you, if you actually hate it, if you actually think it sucks and it's horrible, and this is the worst thing you ever got into, then you still have at least 10 days to cancel it, cut it, and to go back like nothing has ever happened and totally get all of your premium back, 100% back, and we go on like nothing has ever happened. Now, I'm going to ask you not to do that to us, but again, I've only had 2 people do it to me ever. 2 people do it in almost 3,000 clients. So maybe somebody on the call is going to do it. And if you do it, you do it. It's fine. But don't get hung up on that you have to have your specific map. Yes, the map is magical, but there's no magic in the map. It's an Excel spreadsheet. So all you got to do is go to my presentation, and all you got to do is follow along with that example. And if that individual on that example, he has $470,000 in debt, and it was going to take him 18 years to pay it off, But because he put the money in the policy, then we designed the map. We showed him how he's going to pay off that $470,000 in debt. And it's not going to take 18 years. It's only going to take 61 months, 5 years and 1 month. And he's not going to inject the full 470 to pay it off. He's only going to inject $160,000 of outside money. So all you got to do is use a little imagination. And that's what Nelson says all the time. It's all about how you think, Brent. It's your imagination. All you got to do is use a little imagination. So if that map had $470,000 of debt on it, and he's putting in 25 grand a year, and it took him 5 years to pay it off, guess how long it might take you if you had $470,000 of debt and you're putting in 25 grand a year or injecting 160 grand over the 5-year period. Yeah, it's probably going to take you close to the same amount of time. Could be a couple months longer, a couple months shorter. Well, how about if you have twice the amount of debt? Well, it would take you twice as long. If you had half the amount of debt, it would take you half the time. So don't get hung up on this map thing. We are going to create the map for you. We are going to service you till you get sick of hearing from us, right? I mean, because that's what we want to do. We want you around the Kool-Aid, or again, I'm sorry, around the campfire and drinking the Kool-Aid. The more you're around the campfire and drinking the Kool-Aid, the better this stuff gets. So we want to service you because we know the better we service you, guess what you're going to do? You're going to come back and you're going to start more policies with us, and you're going to tell your friends, your colleagues, your coworkers, your family about this process and this concept. So again, don't get hung up in all these like small, minute details. We are going to give you everything plus more than we promise. I'm all about under promising and over delivering. All right. Thanks, Chris.
No worries. Yeah, I love that. Under promising and over delivering is why a lot of times when, our clients see the original 90-minute video and they see the numbers there, and then all of a sudden we do their numbers and they're like, wow, these look better than the presentation. Precisely. And same thing with Larry Lucky Jeans. Your numbers would look better than the presentation. We always try to under promise and over deliver. And I'm going to tell you, the next speaker that we've got is somebody that's going to do the exact same thing. He's going to give you some wow, because we're going to move into some real estate. And I'm going to stop my share here. We got Devin Burr with us today. So I'm going to ask Devin to unmute himself, and we're going to basically put the spotlight on him for this presentation. So I'm not even going to tell his story. All I'm going to tell you is Devin saw me. There he is. And I'm going to put the highlight on him. So spotlight, Devin. There we go. So this is Devin Burr, and he saw Devin, I don't want to tell your story. You tell it.
So, thanks for having me on. So basically,
wait a minute. Anyway, hang on, Devin. I've been spelling your last name wrong, dude. I thought it was Burr. So now I know how to spell it. I'll correct that in a few minutes. Sorry about that.
it is Burr, but that's another story. So I basically kind of just marketed myself as Mr. Burr, the Burr method, but my actual name is Devin Burr, Burr. But the way I actually came about the money multiplier is I heard Chris on a podcast for real estate. He was on Steve Treng's podcast, and I was doing flips. I was doing some things, and I'm like, man, this sounds amazing. This is like something I've got to like research. And it was right when COVID hit. So I had all this time. I started just diving in, reading books, watching YouTube, and I'm like, this, like everyone, this sounds too good to be true. Something's got to be off with this. So that's when I reached out to Chris on Instagram, and I was like, can we have a little bit of time? Can we talk? And then sure enough, we were on the phone, I think like the next day. And the more I asked and the more I found out about it, I was like, wow, this probably is true. And I still was skeptical though. So like I had this capital that I had from real estate, and I wanted to dump it in, but I'm like, what if I dump it in and I just can't get it back out? Then I'm kind of just, up the creek. So I started a policy for my daughter, a smaller policy. It was about $6,000, I think. Dumped that in, tried to get it back out right away to see if it was real, if I could actually do that. I got it out the next day. So when I saw that, I was like, okay, I'm in. I dumped all of our money into multiple policies. So the rest is history. We've been using it nonstop. The money goes in, it comes back out. It goes in, comes back out. It never just sits there in the policy. So we're constantly using it.
Yeah, and Devin, he didn't say this because he's always very humble would be the word. Devin's somewhat of a superstar on TikTok. Now, some of you might not even know what the heck TikTok is, and really that's okay. But a lot of the younger folks out there understand TikTok, love TikTok, and Devin's a sensation on TikTok. What's your one video? What's your highest views you've gotten on that?
I think it's right now at 6.8 million.
6.8 million people have viewed that. How about the how to get all the money back for all the cars you ever buy, drive, and own? What'd you get on that one?
That one's at 530,000, something like that.
530,000 people are learning from this guy how to get all the money back. So what do you want to talk about? I put it up on the screen here.
On highlights.
No, I know. I will. I got it on the screen. I'll put the spotlight on this in a second, but this is your case study that we did for the YouTube video. So any of you that have not seen his case study, you need to go on to the YouTube channel at the Chris Naugle. It is simply magical. I don't know how much of it we're going to get into today, but what he did with his first policies was truly just amazing. And I know many of you, I know Devin's pinned, and we'll change that. But I know a lot of people did see your video, but any of you that did not see it, go on to my YouTube channel and watch it. It will blow your mind because it'll show you how all he did is changed one thing. He changed where his money was going. And then as soon as he did that, it changed everything. It literally changed everything. He made money 5 different times in the same real estate transaction where normally he would have made money 1 or 2 times. So Devin, what do you want to do today? What should we chat about? What do you want to show him?
I actually was thinking about a current flip that I'm doing using the policy, and I was doing the numbers on it. The rate of return, the cash on cash, is just silly. So we can talk about that.
Yep, let's do that. Get out of this.
So just so you guys know, the rate of return, cash on cash on this deal, literally just because I put the money in the policy first, is 9,550% cash on cash return.
Well, I don't think anyone wants to hear about that, Devin. I really don't. How much was that rate of return?
9,550%.
Yeah, I mean, can I get someone to chat in? Is that something you guys want to hear about? Because I just don't think that's enough money. I think we need something that's got a little bit more juice than that, right? I'm totally joking.
The crazy thing is, dude, this is the first year of the policy. As you know, the policies just get better with time. So if this deal was happening in, like, let's say year 5, 6, 7, the rate of return would be 30,000. Like, it's insane. So we can go over that one. It's pretty simple what I did.
Yeah, I think it is. And the time is now for that. So the best way, how about we do like what we did with Brent yesterday, where you just kind of talk through the deal. I'll draw it on the board and just correct me if I do anything wrong.
Okay, cool.
Can everybody see us okay right now? We're both spotlighted so you can see both of us. Is that good? All right, perfect. Let's roll.
So purchase price of this deal was $380,000. Now, unfortunately, I didn't have enough in policies to do that, so I did a hard money loan for that because we had funds out on different deals. But hard money loan for that. Payments on the hard money throughout the transaction were going to be about 15 grand. So that's about 4 months of hard money payments.
Okay.
All right. So then the renovation on the property was going to be about 60,000.
Hey, Chris.
Yeah.
Anyway, hang on a minute. We're getting messages that they can't see everyone. So, Andrew,
want me to just pin myself?
Yeah, pin yourself.
Yep.
Is that better?
Yeah.
Okay. There we go.
Most people can see, so I don't know what might be an issue on their end.
That's probably better so they can see more of the screen. They don't need to see my face, right?
Yeah.
All right, cool. So it's 60 grand on renovation, 15 grand on hard money payments. So all I did is I bought the house with the hard money, right? 380 grand. And then I took a policy loan for the 75,000. So to cover the hard money payments plus the 60,000 in renovation. So that's what I used my policy on, is 75 grand from the policy to cover everything that it was going to take out of pocket on
So
the
how
deal.
much was the loan?
75. So it covered hard money and reno.
Okay. So this was a loan, and your plan, I know, is 5% loan interest.
Yep.
Okay, so we got your IBC plan here. You took a loan of 75,000, and that loan is going to pay for the reno and the carry cost, right?
Correct.
Okay, so this loan,
So
well, hold on, I got to stop one thing, because your policy's in your personal name, right? This is your personal policy. So did you loan this to your company?
exactly. So that's the next part, is I created a note to myself from the company of 15%. So I'm paying myself back interest payments of 15% on the 75,000.
Okay. So we use that for the reno. So the loan was used to pay for the payments as well as the reno. So it would have been the same thing. This 15 grand and this 60 grand would have come out of probably your corporate bank account. But what you did is you just loaned that money to your company at a rate of 15%. Where'd that number come from?
That's just usually what I get hard money payments at. So
you just basically did the same thing that everybody else was doing to you.
Yep.
Okay.
Now I took that 15% payment, which is on an auto payment, into a high yield savings account,
So
which that amount just keeps going down, unfortunately.
And what is your high yield savings account?
It's at a 0.5% now. So nothing crazy, but still a little bit more money being made.
Hey guys, real quick, can you just tell everybody the premium that you put into the policy, and then because I think they're having a hard time figuring out where the 75 is coming from.
So that was just funded at the beginning or at the middle of the year. I put like 150 grand into one policy, and I used 75,000 of that 150 grand policy.
Yeah, you did a dump in, I think it was of 150, if I'm not mistaken.
Yep.
Okay. And then up
So I used 75 of it for the policy loan.
Perfect. Thank you.
Yep. So yeah, 75 policy loan paid for hard money payments and reno. I paid myself 15% interest on the 75,000 that went directly into a high yield savings that paid me another 0.5%. And when I exit on this deal,
real quick,
the
Devin,
exit price.
Savings, is this your segregated bank account?
Yep.
Okay, that's what we've been calling it the whole time. I just want to make sure everybody understands different use, high yield savings, but this is just a segregated bank account, like my little checkbook I held up yesterday. Sorry, I didn't mean to interrupt.
Oh, no worries. So that's pretty much it. Now the exit of the property is going to be, we're hoping 599, but the way the market is out here in Phoenix, it actually might be higher. So 599 would be the exit. After closing costs, commissions, profit will be about 115,000.
Okay.
And then there's the profit from paying myself 15%. Plus the profit from the 0.5%, plus what was made in the policy.
Yeah.
So total, if you want to write this down, I actually have the notes. The total that I'll make on this deal will be $119,375.
Got ahead of myself. So this is your profit, your net profit.
Yep.
Okay.
Now, when I tell people this, they're like, wait a minute, you spent 75 grand. How is your cash on cash return so high? But people don't realize that I didn't spend my 75,000. My 75,000 is sitting in the policy protected. I didn't use my 75 grand. The only actual money out of my pocket is the 5% interest payments to the insurance company.
That's right here.
So if you take 5% of 75,000, I only paid $1,250 out of my pocket to go and make 119,000.
And that was that 5% interest everybody's always getting upset about that the insurance company charges, right?
Yeah, it's so horrible. They charged me $1,200 to go make 120.
I know.
How dare they?
How dare the insurance company make some money? So it cost you out of pocket $1,250. You made $119,375. Some people would say, well, hold on a second. You had to put in 150 grand, so it didn't not cost you. That was 75 was your money. But where was that 150 sitting before you started this?
I was sitting in just a regular bank account, business bank account, making 0.06% interest.
Wait, so before the world of being your own bank, your bank account paid you how much?
0.06.
Okay, that's a pretty darn insulting rate. So just so everybody realizes, like Devin, had the money sitting in a regular account, just like most real estate investors have money. I mean, I have very rarely met in a real estate investor that's successfully doing deals that actually doesn't have money in their bank account ready to do, a deal or pay closing costs and monthly payments. Matter of fact, a hard money lender wouldn't have given Devin a loan unless he could prove that he could make those payments, had some assets. They want skin in the game too. So this is just money he had sitting in a regular account. And he saw this and he's like, screw these guys at their 0.06. I want to make 4% plus dividend. And then I can use the money without ever having to take my money out to make uninterrupted compound interest. So he just basically did the same thing he was doing before. But how many things did you have to change to make this actually happen?
Two things. First thing and the most important thing, I had to change my mindset. I had to change my mindset on how money works and the banking system. So I changed that first and foremost. And the second thing was just where my money went.
So where your money went. So two changes. I wonder how many people out there are capable of making two changes or adding two steps to their entire process to do something like this, where this was $1,250 true out of pocket to make a profit of $119,375, and doing all of this with that wonderful world of real estate that you were doing before. So I don't know. I mean, I bet you a lot of people would love to learn how to do what you did here. So let's real quick.
It's not technically difficult. Like, it's actually pretty easy. It looks kind of difficult, but in theory, it's actually very easy. The hardest part is, again, just changing your mindset around it. Changing your mindset that, like, oh, this isn't how it actually works. And no, it is. It's exactly what banks do all day long.
So the first thing you did is you changed where your money went. Well, first thing really, you changed your mindset, where money went. Right. What was the second thing you had to do? How long did it take you to take that loan?
I think it was a couple days.
So like 3 days?
3 days tops. Yeah, I'd say 3 days tops.
So, and I'm not saying, folks, I'm not saying that 3 days after he put the 150 in, because he did another couple deals before this one. But what I'm saying is that when he clicked the button, I think you just log online, or do you do that through the mapping team?
I just go online.
Yeah,
on my dashboard.
You can go on your dashboard and just click, take a loan and put in what you did. You took 75,000, or you could have called the mapping team and said, hey, I need to take a loan for 75, and they do it all. So you can do that. But once you click the button, what you're saying is that money was in your account in about 3 days.
Correct.
Okay, 36 hours. Perfect. Now, after that, what did you do? You deposited that money into your corporate bank account?
It went directly from the policy into the bank account.
Yeah. And then the only thing there was that note saying that you were going to pay yourself 15%. So that would be the third thing.
Correct.
You created a note. Okay. And then how long did it take you to set up a segregated bank account?
5 minutes online, if that.
Okay. We'll say for the average person that's not Devin Burr, probably take them 15 minutes online to set up that. So you set up the segregated bank account. Okay. And then how did you do these 15% payments back to yourself? And like, how did that work?
Just an automatic, like kind of like a bill pay. So just
A bill pay.
automatic payments
So we'll call
of
that
that amount.
Yeah.
What's that?
No, I'm just saying that's the fifth thing you had to do. I'm just kind of laying out how many different things you had to do to make this work. Change your mindset and where your money went. Then once it was there, you had to click a button, which takes I've done it for people. It takes literally about a minute and a half to log in and click it. Then, drafting a note took a little bit of time. Setting up your high yield savings account, your segregated account took some time, and setting up that bill pay, boy, that was tough. And then how long is it going to take you to finish this deal?
It's a 4-month process on this one.
So 4 months there. And then what are you going to do when you do sell it and you realize that 115,000 net?
So I'm probably going to do a 1031 exchange. But I'm also going to take whatever obviously I took out, which is the 75,000, put that back into the policy.
So you're going to repay yourself 75 grand so that now your plan now has 150,000 plus whatever money, it's made in interest and dividends.
Right. But the 115, that's after paying back the policy already. So that's my actual profit. Yes.
All right. So this is net of loan repay. Wow. That's a heck of a deal.
Yeah, that's paying back the loan, everything. That's what I actually keep.
I think a lot of people would have a hard time finding.
Gotta love Phoenix real estate.
What's that?
That's the hardest. Gotta love Phoenix real estate,
Yeah,
but that's the hardest part is just finding the deal. Like, this is actually the easy part, just structuring how to use the policy, but the hard part is finding that deal.
Absolutely. That's phenomenal. So let me unpin myself here, and I'm going to pin you. Let's see. How do I do this?
Hey, Chris.
Yeah, go ahead.
Anyway, so hang on before you unpin him. Oh, I was going to there was some
right.
I wanted you to write on the board.
Go ahead.
There's some I wanted you to write on the board, and it came from some content that Devin shared with us. So anyway, I was taught by an old mentor of mine, and this has played so true in my life. He said there's 3 things you definitely need to have. And I'm going to tell you these 3 things, and I want you to write them down if you would, please, Chris, on the board so everybody can have them. The 3 things. Number 1 is mindset, right? So the thing is that you have to get your mind right, okay, about this stuff. So mindset is number 1. Number 2 is systems, right? So basically the thing, you have to have a system, and that's what we're creating here with this banking concept, right? We're creating a system. And the third thing is mentors, mindset, systems, and mentors. And that's what we here, in our organization at the Money Multiplier are trying to provide with you, number 2 and number 3, the systems of how to do the stuff that you want to do, that now you have the mindset to do. And now we've got the systems put together, and now we are the mentors that are going to help you implement those systems. But it all starts with what Devin Burr just said, man. It's mindset. Mindset is number 1, and it's just all in how you think. And I'll take you back to the backward bicycle, because all this stuff we're talking about all through the weekend is not what your parents are teaching you, your grandparents, your friends, your colleagues, your coworkers, right? Whoever your financial advisors, CPAs, professionals, they are not teaching you this stuff because they don't know it. Nobody has taught them this. Just ask Chris. He was a financial advisor for New York Life for 14 years. They never taught him anything about that. So yeah, Devin, that was awesome, brother, man. That was really, really powerful. That was fantastic. And you are just going to town. You have supercharged this banking concept. You should be very proud of yourself. And I mean, it's only going to get better as time goes on and you build more and more policies and do more and more deals, and you're recapturing and you're recycling all of that dollar. So great job.
I would
I got to catch up to your 19 policies, Brent.
Go get there, brother.
We're all playing catch up.
Just remember, I'm way older
I'm
than
at
you
5,
are, dude.
so yeah, I'm at 5, so I'll get there soon.
Yeah, but wait, you're at 5 policies, and how long have you been doing this now?
First policy opened in May.
Wow.
There you go.
So what's that? 8 months.
So Brent,
Tell them your net worth.
Yeah.
The net worth is quadrupled since I started this.
May.
Wow.
Unbelievable, man. Well, we're super excited to have you as part of the Money Multiplier team, and we're really excited for the things we're going to do with you in the future. And thank you for everything you're doing. Thank you for spreading the word on TikTok, and thank you for sharing your story and this awesome deal here with everybody on this virtual training today. So you guys all like that? Were you guys into that? If you were, make sure you follow Devin. He's on Instagram and TikTok, and his name is DEVIN and BURR. So you did not the Mr. Burr, but I think is your TikTok Mr. Burr as well?
Yeah, it's just like this, Mr._Burr. That's my handle for everything.
His videos on TikTok literally like has everybody here at the Money Multiplier looking at him going, what? They're that good. So folks, check it out. He's blazing a path just like all of you need to do. So Devin, thanks for your time today, man. I appreciate it.
Of course. I'm going to stay on and keep learning. So.
All right. Well, coming up right after you, man, we've got the studio guest, another one of our clients, Joseph. You haven't met Joseph yet, have you?
I don't think so.
So we're going to bring Joseph on, and we're going to kind of go to a PowerPoint and talk about what he did. And Joseph, we get asked all the time with people that, how do I unspotlight myself? So it's just the regular, there we go. So that everybody can see how Joseph, well, number one, you want to talk about mindset. It took 1.5 years. I'm going to have him tell that story because I can't do it and stay calm. So it took 1.5 years for him to actually come in and understand this and wrap his head around it. I'd almost given up on him. Brent didn't. Brent's like, hey, Brent and Hannah are like, hey, what's going on with that Joseph guy? I'm like, I don't know. I just saw him at the RIA again, and he's thinking about it. Well, what do I got to do? Brent's like, do I got to jump on the phone with this guy? And what we're going to do is we're going to go to the PowerPoint in a second when Joseph tells his story, and we're going to show you what we did with his plan and how he's using his home equity line of credit in a very unique way, a way that literally I'm taking notes and starting to kind of look at it and say, all right, well, can I do this? So that's what we're going to do now. So Joseph, tell him a little bit about your story here.
Thanks, Chris. Thanks for having me on. I was a tough nut to crack. He kind of gave up on me. I nerded out on the numbers and was worried about how much I was spending. And he's totally correct with everything. This is just a bank account. And once I finally understood that and understood that I wasn't losing money and everything was working to my benefit, I enjoy it and love everything with it. I first realized when I went to buy my Escalade, I was going to pay cash for it, and took the check and handed it over and realized, oh my goodness, what did I do? I should have put this into the policy first, borrowed it against, and the next day I called up and got a policy.
I remember that too. I remember it vividly. I'm like, you sure? I'm like, you sure you're ready?
Oh, I'm definitely sure. I spent a lot of money and learned a hard lesson.
They're nice Cadillacs though.
Well,
nice Cadillacs, but
it
it was
would
a
be
nice
better
check.
if I could get it for free.
It sure would. It really would.
Pay myself back.
So one of the things that we put together, Andrew and Joseph worked on, you guys worked on this for how long now? Because Andrew's doing your mapping. So
Yes.
how long have you been doing this, with this policy?
About 6 months.
6 months. And is this your only policy?
Right now, while I'm getting my daughter's 2. She's
Okay.
10 years old, and I'm starting her up.
6 months. He's got one on himself, and then also starting one on his daughter. Now, Brent, could you, or Hannah might know, out of in the first year, you guys have like a percentage of all the members, and how many of them actually set up their second banking policy in the first year, which is a staggering number. What is that number?
It's about 91%.
91% of every one of our members start their second banking policy in year one, going into year 2. Why did you start your second one?
Because it's awesome.
Okay. A lot of people will say that they looked at the first one, they thought it was too good to be true, and they put a little bit in. They dip their toe and they're like, boy, I wish I could put more in, and you can't.
I wish I could have put more in.
Yeah. So that's why most people do it. So do you want to jump right into the slide? I'll share my screen here quick, and we'll dive right into what we created here for you, because this is really interesting. And I'm going to stop talking. I'm going to have Joseph just kind of walk through this as I get it up, and I'll just click as you go. So just like we saw before, we're going to use the exact same format as yesterday. And here we go. All right. So we start there with your money multiplier plan. And how much did you fund your money multiplier plan with? 200,000. And that was a dump in, right?
Yes, it was.
Because I know Laurel was asking about the dump ins, and I'll have Devin talk about that in a second. So you did a dump in. Now, where did the money come from? Yeah. So let me just get it all up here, and we're gonna walk through. It's just easier if I put the whole thing on the screen. And now what we're gonna do is I'm gonna grab my little handy dandy pen, because people are looking at a lot of things. Where'd the money come from to fund this plan at 200,000?
Well,
because there's not a lot of people that have 200K just sitting in a bank account.
It started with my HELOC. So I went to the bank, and it cost me $0 to get a HELOC. They paid for everything. So then I went in and I took the HELOC and I borrowed it at 2%, because that's what my HELOC costs. And I put 200 into the policy. So the policy grows at 6% because of the 4% and the 2% dividend. So technically I'm making 4% right there. And then when I loan it put it in my bank account to myself, to the company at 8%.
So what you do is you take a loan from the insurance company at 5, it costs you 5%
Yep,
simple interest. Then you actually take the money from your segregated account and you lend that money to your LLC.
To my company.
Okay.
Yep. And then out of the company, I lend it, being a private
Well,
borrower.
to me, I mean, you've lent money to me on real estate deals.
Absolutely.
So I've borrowed money on numerous real estate deals from Joseph at a rate of 10%.
That's correct.
And then, so I'm paying him back the 10%. So, how much was that last deal over there in Lancaster? What was that deal? Do you remember?
125.
125. So, if we just we'll just go back and we'll figure this out. Andrew, do you have a calculator you can pull up? So just if he took out of that 200,000, if he took 125, this is a real deal, folks. We're literally showing you something that actually happened. What is a monthly payment at 10% on a $125,000 loan? How much was I paying him every month? Interest only. Yep. 125.
125 at what rate?
10%. And what was the monthly payment that I gave him? Yeah, 6.
Over how many years?
Just simple interest. Are you trying to use? That's okay. Here, it's just a calculator. I'll do it for everybody. I got it. I got you, man. I got you. See, Andrew is like 3 steps ahead, and he's going into his advanced calculators when all we need is just the one on your iPhone. If you guys are looking at this, we do 125 times 0.10, or you could do 10%. That's 12,500 divided by 12. That means 1,041. That was exactly what it was. Believe me.
The number.
Yes. So Andrew would have had a full amortized loan schedule on your desk in T-minus 2 minutes. All we needed to do is just figure out how much money I was paying Joseph. And I don't know, that deal took way too long. How long did I pay you that for?
1 year.
Was it only a year, or was it a little longer?
It was a year.
Shit. It was exactly. So I paid him, and literally we struggled with this deal. It was a pain in the ass, but we paid him every single payment. So he made $12,500, and that's what he used to, put gas in his Cadillac or something. But what he then did is, instead of 12.8 or 12.5, in that, if he took, a loan, so let's just assume that your loan was 125 to fund my deal. So you took that loan. Now let's just do the math here.
Of free money.
That is true. 125 times 0.05. So you're going to give that insurance company that terrible insurance company that's actually allowing you to take your money but still pays you 6% on yours. Shame on them. You're going to pay them $6,250 over the year. But then you took that 125 and you did a note to your company at 8%. So folks, so you guys, if
that 8% covers my 2 plus the 5 of 7%. So technically I made 1% there,
it's 10 grand.
6% in the policy. So that's 7% plus your 10, which is 17% on free money.
Oh, I never thought about that. Yeah, I totally forgot about this HELOC because obviously you got to keep paying for that. So instead of
17% on free money.
Yeah. So you're basically paying your HELOC, you're paying your 5%
with this,
and then some.
But
with
I
the
made
loan
1%.
You made to your company.
Yep, I still made 1%.
Yep. Okay.
Yep.
So you got 10 grand. Yep. So you know we got 5, 6, 7. So you're losing 7 in the middle. Okay. You got So you got 1% we picked up there, but you really don't care about
6%, 6% in the policy.
But
plus the 7, and that's 10.
We don't want to get people too excited here. You know, we're trying to keep this actually going in a nice, cool level. So we just got to keep them. Let's just talk 1% here. Right. We know you're making money there, but then you didn't just leave the money sit in your corporate account. You actually then found a schlep like me that'll pay you 10%, and you loaned the money to me on that Aurora Street deal in Lancaster. And what was the address on that so they can look it up? Because I want people to know that like we're not just making this up. 286.
That's
so,
right.
Gabby, can you put this in the chat? 286. Aurora Street, Lancaster, New York. Any and all of you can Google that and you can see the deal. That is the deal that Joseph funded for us. And it is the deal that me and Larissa struggled through to get this darn house on. It was a bank foreclosure. So I just want everybody to know, like, we're not making these up. This is a case study. This is a real story that actually happened, folks. So I'm just kind of trying to show you all those numbers. There you go. And this 12.5, that was more than enough to pay that. So you're just basically making money. So like, how do you tell somebody that this is real? I know you go to your fire hall meetings and you try to explain what you're doing. Like, how do you explain this to them?
It's hard to do it. I told them that it's the best thing that's ever happened to me, and you just keep making money on free money, and it just keeps on going on until the next policy. I'll make more, and it will just get better than that.
You know, and one thing I love about it is, you know, we get asked all the time about the HELOCs. We get asked all the time of the people that have their home equity lines of credit and they're like, oh, how do I use it? Well, this shows exactly how you're using it.
Absolutely.
And there's lots of ways. And what we're going to do now is we're going to actually have Brent. Let me just clear my screen. He's got another example of how a home equity line of credit can be used. But hold on. I think I got one more slide here I want to show for you, Joseph. Did we do one more?
Hey, real quick. Sorry, guys, to interrupt, but there's a lot of people asking, Joseph, what bank you used for the HELOC.
Oh, yeah.
Community bank. I use Evans Bank.
Hey, Chris, can I add something?
Yeah, please.
So I thought my rate of return of over 9,000 was good. This is an infinite return.
Great.
Literally an infinite return. 0 of his money's been used.
That's correct.
To go make money. Even if he made $1.
That's what I told Chris. I said that if Devin used the home equity line, he wouldn't even use his own money, and you would make even more money.
You know what's crazy is I've got an equity line. So, hey, Chris, we need to start another policy.
There you go.
All right, man. And there you have it, folks. See, it's just sometimes you just got to crack the egg. That's all you got to do there. Like these home equity lines of credit, for any of you that have equity in your house, for any of you that maybe have an equity line that you're just not using, I need you to really take and very seriously imagine what is going on. I want you to imagine one of your worst days from coming home from your job or your business. You come home, it was just an awful day. And you open the door and you look over into your living room, and right there in your living room is your money. And it's sitting on your couch. It's eating your potato chips. It's drinking your soda. It's watching your TV. And it looks over at you and it says, what, did you have a hard day? Your lazy money, and you saw the video with Shauna yesterday, but your lazy money is that dollar sitting on your couch. And until you learn how to move that money and use that money and make that money go to work, Joseph and now Devin are going to go over to that money on the couch. They're going to grab it by the shoulders, lift it up and say, you know what? You're going to work tomorrow. You're never coming home. You're never getting a vacation. I'm never, ever going to allow you to do anything but work and work and work. And you know what your money will do when you do that? It won't be scared. It won't be like, oh, no, I don't want to do that. It will smile, look at you and say, thank God, Joseph and Devin, I've been sitting here so lazy. You just ran out of Coca-Cola. Now I'm drinking this Barks root beer shit. Like, you literally almost had it to the point where I ran out of potato chips and you didn't tell me what to do. And thank God you're telling me I will never come home, Joseph and Devin. I will work as long as you want me to work. Just please, please make me work harder. That's what your money will say. That's all
Chris,
your money
the
knows.
imagery that you just gave us, like,
Was it
I'm
the
impressed.
Berkshire that did it?
I think that was it. I always tell people, it's like, I view my money as little soldiers. I deploy those little soldiers out and they go make little soldier babies. And then those babies go out and make more little soldier babies. And not until there's a lot of babies out there, then the babies come back to me. That's it. So that's how I view it. But I love how you view it as well. It's great.
I think we like yours, Devin. I see that's going to be the next
nice.
TikTok. We're gonna have an animated view of like a little, like, the green army men, like they're going to be little green money men, and they're just going to basically start reproducing, and like you're just going to have a whole problem of too many of those little green army men, money men.
It's TikTok though, so you got to be PG about it,
Yeah, that's true. That's true. Well, Brent, I think you got to have a talk with Terry about. She always wants to have your money men, your marching dollars working. Well, are your marching dollars reproducing?
The green men, man, you got to get the green men working. These are powerful stories, man. Devin and Joseph, that's awesome stuff.
Awesome, man. Well, hey, thank you so much.
Thanks for having me on.
All right, folks. So we just wanted to get some people up that were kind of using this to tell their stories, and that's it. So you've heard from Devin, you've heard from Joseph, and now Devin picked up notes from Joseph, and I'm sure Joseph is learning from Devin. You see how it works, folks? Mm-hmm. All this is getting you around the campfire. The longer you sit around the campfire, the more things you're going to pick up and learn. So with that being said, we're going to kind of roll through, everybody, we're almost at the lunch break, and it's not a lunch break. It's a 15-minute break. But what I want to do here real quick is just play a video. And then what I'm going to do is have Brent.
Chris,
I want to have you do your HELOC example.
Oh, okay. All right. I
just want to get through this just to kind of get you all to understand about what it looks like to sit around the campfire. So this video is for you, folks.
I know you've heard me say this a whole bunch of times, but you can never hear this too many times. These are some really important things that you need to learn, and not just learn, you need to apply these in your life. No one else is going to teach you this. You've got to start seeing the big picture. Good fortune's not going to just fall into your lap. I don't know if that's what you think is going to happen, but it isn't going to happen that way. You're going to have to work for it. You're going to have to.
Someone said there's no sound. That's weird. We're going to just fix this real quick. Give me one moment, because this is the campfire and you guys got to get around it. How do we turn up the volume?
I know you've heard me say
there we
this
go.
a whole bunch of times, but you can never hear this too many times.
That's maxed out.
These are some really important things that you need to learn, and not just learn, you need to apply these in your life.
All right, listen
No
carefully.
one else is going to teach you this. You've got to start seeing the big picture. Good fortune's not going to just fall into your lap. I don't know if that's what you think is going to happen, but it isn't going to happen that way. You're going to have to work for it. You're going to have to do what everybody else is unwilling to do. You're going to have to grab it by its you-know-what. You get what I'm talking about. You can learn from the wealthy just like I had to, but I'm going to save you a lot of time, because I've put years and years into this, and I've failed enough times where you don't have to fail. You just got to listen to me. Are you paying attention? There's a specific reason the rich keep getting richer. They know something that you and I don't know, and that's what you need to know. Do you know what I mean? Scouty, are you listening to me? I'm going to take that as a yes. Now, get up and go get us a beer.
You're going to do just fine. Everybody loves orange hair. I should know. It looks great on camera. You won't mess up your lines. If you mess up your lines, Kyle will just tell you them. You practice all night for this. It's your time to shine. You can do it. I believe in you.
Okay, maybe I'm biased, but that one by far is my favorite one. Simply because it's my cat. All right, Brent, take it away, man.
And that was awesome. And for all of you guys that don't know, the one there with the red hair is Shauna, our very own Shauna.
Absolutely. I love it.
No, the two-legged one, not the four-legged one is Shauna, the two-legged one. All right. All right, Chris. I think you want me to show the HELOC, right?
That is correct.
Okay, here we go. Can you see my screen okay?
Got it good. Yep.
Okay, good deal. So this is a HELOC policy. Let's see, when did this one, what are the details on this one? It was a Lafayette Life Heritage policy. It was on a female.
It's blurry.
Oh, okay, wait. They're telling me it's blurry. Hold on, stand by. Hannah's bringing it up here. So as Hannah's bringing it up to make it not blurry, so I want you guys to be thinking about this home equity line of credit example we're going to talk about. So a lot of you guys have equity in your homes, right? So yes, there's equity, or maybe your home is completely paid off. Well, I want to ask you this question. How is the equity in your house actually helping you? Okay, hold on.
Not Mexican.
It says HELOC example right here on the desktop.
Gotcha.
So anyway, okay. Nope, not that one. It's not that one. Here, hold on. I got to help Hannah find this.
This one.
Yeah, you got to go to HELOC on the desktop.
I know.
Under H. It should be the HELOC example right there.
Yeah,
That should be it. Make sure it is. You want to?
Yeah.
Okay. So anyway, all right. So how is the equity in your house actually helping you, right? A lot of you have equity in your house. Well, it's actually not doing you any good other than giving you the peace of mind, right? Knowing that that house is paid off. So in your home, if you have equity of any dollar amount, whether it's completely paid off or whether you owe X amount on it still, okay, so there's equity in your house that could be used to help jumpstart your policy. Now, keep in mind, so this is not for everybody. No, it's not for everybody. You have to be pretty disciplined with your money in order to do this. But I'm going to show you an example of how we can jumpstart a policy by using your home equity line of credit. Now, if you remember from what we've been talking about, the thing that we do is when we design a policy, a typical, let's say it's a 40% base, 60 PUA split, the thing we will do is pay the base and the PUA for the first 5 years, exactly the way I show you in the mapping example on my recorded presentation. Remember how he paid $25,000 a year and then he dropped it down to $10,000 a year after 5 years? Well, I'm going to say that you have $20,000 of premium that you want to commit to a policy each and every year. But if you want to commit that 20 each and every year to a policy, eventually we're going to have to drop off that paid up additions rider, and you won't be able to continue to put 20,000 a year into the policy, because when you drop it off, when you drop that 60% off, now you're only going to be able to put 8,000 in the policy. All right. So in this example, I'm going to show you how when you come out of pocket every year for $20,000 of premium, you're actually starting the first 5 years of the policy with the $50,000 in premium, which is a 60% increase over $20,000. So in this example, the thing that you see here is on the left. All right, all it has is age, and obviously the age doesn't matter. It doesn't matter if you're younger or older. This was just the example that we used, and it gave us these numbers. All right. Now, if you notice in policy year, all that is time. It's year 1 to 5, 6 to 10, 11 to 15, so on. All right. So this is going to go on for a total of like 30 years. A total of 30 years is how we've got this set up for. So in the very first year, if you notice in the column where it says annual premium to insurance company, we're actually putting in $50,000 of total premium. And I want you to look to see where the money is coming from. Do you see the out-of-pocket funds? So 20,000 is coming out of pocket, and the other 30,000 is coming from a HELOC. Now, in this example, okay, I'm going to say that you have $150,000 of dollars in your HELOC. You have $150,000 of equity in your house, and the conventional bank is going to loan you or $150,000. In other words, they're giving you a home equity line of credit for $150,000. And in this example, the bank is going to charge you 5% interest on this home equity line of credit. Now, also keep in mind that a home equity line of credit is going to be based on simple interest. Most HELOCs that you see out there, all you have to pay is the interest only on that home equity line of credit. For example, all right, let's say you're going to borrow a total of like $30,000 and the interest rate is going to be 5%. Okay. So if you take $30,000 times it by 0.05, all right, that means it's going to be $1,500 a year in interest to borrow that money if you keep it out for the full year, the full 365 days. If you only kept the money out for 6 months, then it wouldn't be $1,500, it'd only be $750, right? It's most of the HELOCs that are out there, they're based on simple interest, and all you're required to pay back is interest only. Interest only, and most of the time you do this on a monthly basis. All right? So in the very first year of the policy, his annual premium that he's going to pay to the insurance company is $50,000. Well, how much of that $50,000 came out of his pocket? Only 20,000 came out, right? Only 20 came out because the other 30 came from the home equity line of credit. So his total premium is 50,000. Well, how much cash in this example does he have to be able to use? It's 29,000 and some change. All right. So how much did you have to come out of pocket with? You only had to come out of pocket with 20, and you already have 29 that you can use because the other money came from the HELOC funds. Now go over there to where it says HELOC interest. Now, even after we pay the HELOC interest that year of $1,500, which is 5% of 30,000, you still have 27,700 that you're able to use. Okay. So I'm just showing you now how the money that you have that's in your HELOC can now start to do you some good, because before it wasn't. It was just sitting there in equity. And you weren't using the money. Other people were using the money. The bank was using the money, right? So now all you're doing is putting that money, that equity, I call it like the dirt on your property, you're putting that money in motion. So now in year 2, we pay the premium again of 20,000 out of our pocket, but we borrow 30 from the HELOC. Remember, I said your HELOC line is 150,000. So we're only using 1/5 of it, 1/5 of it each year. And we're going to use the 150 in a total of 5 years. Okay. So in year 2, you come out of pocket with 20, you use 30 from the HELOC. So the annual premium you send to the insurance company is 50 grand. That's what you send to them is 50. Well, how much is your cash value that year off of that 50? It's 30,000. Well, even after you pay the HELOC, even after you pay the interest that you owe to the HELOC of $3,000, because now, okay, remember, now you're paying 5% on a total of $60,000 in money, because you have 60,000 borrowed out from the HELOC. Well, that means 5% is $3,000. But even after you do that, you still have $27,000 of that year's money that you can use. And how much did you come out of pocket that year? only 20. So that year you have 27. So in the first year you had 27, the second year you have 27. So if you look at the cumulative growth in year 2, you have just under $55,000 of money that you're able to use for whatever you want, products, services, investments, whatever you want to use, and you've only come out of pocket with $40,000. Okay? Let's go to year 3 because it gets better over time. Just like Devin said, it gets better with time. Just like Joseph said, each day is better than the day before. So now in year 3, once again, you come out of pocket with 20. You use another 30 from the HELOC. So now you've used 90 total. So again, this year you pay premium of $50,000. Okay. And you, of that 50, you have $35,000 to use. Well, now we have to pay interest on $90,000 at 5%, which is $4,500. Well, even after you do that, you still have $31,000 of that money that you can use right now. And all you did is you came out of pocket with 20 grand. And if you want to look at the cumulative, you've got $86,000 that you can use. So up to this point, we've done this 3 years now. All right. We made 3 premium deposits. So really it's only 2 years and a month, right? Because we made a premium deposit in month 1. We made a premium deposit at the end of the first year, beginning of the second year, which is month 13. And in the third year, we made a premium deposit the end of the second, beginning of the third year, which is month 25. So really we're only 2 years and 1 month into this thing. All we've done is we've come out of pocket so far with 60 grand. We've sent 150 to the insurance company. And out of the 60 grand that we've come out of pocket with, we've paid all the interest on the HELOCs and we got $86,000 in cash. All right. Year 4 just gets bigger. We put in another 20 out of pocket, use 30 from the HELOC, a total of 50. Out of that 50, what do we have? Almost dollar for dollar now. We got 49,000 and some change to use. Now we have to add in the other interest for the other 30,000. So now we have $120,000 borrowed from the HELOC, all at simple interest, which is basically $6,000 a year. Remember, 5% of 120 grand is $6,000. Even after we pay the $6,000 in interest in year 4, we still have $43,000 that we can use that 1 year. So we put in 20 out of our pocket. We have 43 we can use. The cumulative is 129 and some change. So finally, year 5, because all we have is 150 to use in the HELOC. So now we do the same thing in year 5 that we did in year 1 to 4. We come out of pocket with 20, use 30 of the HELOC. Total premium to the insurance company is 50. And we've got more to use than we put in. We put in 50, we got 51 and some change. Now we have $7,500 in interest that's going to be owed each year in home equity line interest. So, right, 7,500 is 5% of 150,000. We got 43 and some change, and a cumulative now of 173. So, here's a couple questions I have for you. Okay, the thing that we do is we have this HELOC. Okay, so now the thing we do is we owe the money to the bank. We owe 150,000 in the HELOC. Now we can continue to use the HELOC, and if you notice as the years go down in HELOC interest, okay, all we're doing is we're paying the interest. We're paying the interest each year, and I've taken all that into account in the numbers that I'm showing you on the net growth per year and the cumulative growth. Or, so let's say you're tired of the bank and the thing you want to do is just get them out of your life. Well, that's okay. You can pay the HELOC off if you want, because you have $190,000 or you have $173,000. So could you pay the HELOC loan off if you wanted to, and then you would no longer have the HELOC interest to use? Yeah, you could do that, but is that a very smart thing to do? I don't know. It depends on you and your financial mindset, as Devin Burr talked to us about. What is your financial mindset? Well, let me tell you what my financial mindset is. I will borrow money from a bank all day long at 5% interest, especially 5% simple interest. All day long, I will borrow money from them, because guess what I can do with that 5%? I could maybe do the same thing that Joe does or the same thing that Mr. Burr does. You take that money, you're going to use the money that's already there in the equity of your house, and now you're going to go turn it into more money. You're going to maybe make 8% into that money, maybe into an investment property. Maybe just like Joe, he loaned money to Chris Naugle to do a real estate deal. Maybe Devin Burr is going to go out and buy another piece of investment property, right? Absolutely, ladies and gentlemen, boys and girls, I'm going to use the bank's money all day long at 5%, and I can go out and make 8, 10, 12, 14, or do whatever that I want to do. Absolutely, I'm going to do that. Is this for everybody? No, because you have to be disciplined with money. A lot of our clients are very disciplined with money. A lot of our members, they're very, very good with money. But I will tell you that we have some members on our, that they think just because they have checks left, there's still money in the bank. So if that's you, if that's your mindset, and if you think just because you have checks left in the checkbook, you still have money left in the bank, then this may not be a good idea for you. All right. Just saying. All right. So now we're going to continue on, and we're going to look at year 6 all the way down to year 30. Well, now at this point in year 6 going forward, what have we done? We have dropped the paid up additions rider off of the policy. So now we're just paying $20,000 a year, okay, out of pocket. Those are all out of pocket funds. And I want you to look at the growth as we do that, okay? I want you to look at year 6. Well, the thing we put in 20, we've got 24 to use. We put in 20 in year 7, we got 25 to use. In year 8, we got 27. Do you see how all these numbers go up? They just keep going up. It's up to you if you want to continue to keep the money out of the HELOC. I would, because I would be taking this money and I'd be putting it into an investment. I would be doing a policy, or so I would be doing a hard money loan or buying a VRBO. Or I would be doing something with that money to keep my money moving. Remember what my wife says. She wants the green men moving. She doesn't want them sitting stagnant. She wants that money in motion, and so keeping that money in motion, it also means not having the equity sit in our house, because what good again does the equity give you? It gives you a peace of mind. That's all it gives you. Other than a peace of mind, it's not doing crap for you. So you use the money. And all these numbers just keep getting bigger. And keep in mind, you can pay that HELOC off at any time that you want, part of it or all of it, because look at the cumulative growth. And on the far right-hand side of the column, it just keeps getting bigger. There's way more than 150 grand there if you want to pay the HELOC off. Okay, so let's see just what we have done through a total of 30 years just doing this. Now, okay, so keep in mind, this is just all you're doing with this is you're simply starting a policy for $20,000 a year out of pocket. But in the first 5 years, you're going to pay an extra 30 grand from the funds of the HELOC. So it really didn't come out of your pocket. It just came from the equity you already had in your house. Okay. So, okay. And then all we're doing is just on the policy. The thing we're doing is we're buying the policy and we're letting it sit on the shelf, which again is the worst thing you can do. But okay, because I'm not showing you any activity of the banking concept in this illustration. All we did is used our HELOC policy to jumpstart our policy. So instead of putting in 20 grand a year the first 5 years, we can put 50 grand a year in the first 5 years. But I'm not using this policy for banking. I'm buying it and I'm letting it sit on the shelf, which is the worst thing you can do. And let's see what we have here after 30 years. Well, how much out-of-pocket money did you come out of? You came out of pocket with $600,000, right? 20 times 30 years, 20,000 times 30 years is 600 grand. You took 150 out of the home equity line of credit. So really what you did is you dug up $150,000 worth of dirt, okay, so in your yard, and you're just going to put it into the policy because you weren't using the dirt anyway. It was just sitting there. You were stomping on it. The kids were playing on it. You were mowing on top of it, right? So really you only came out of pocket with 600, but when you add in the HELOC funds, 750 total. Well, how much cash do we have in the policy? We have a total of 1,100,000, right? So is that more than the 750 you put in? Absolutely it is. Well, I'm not even going to count the dividend. I'm not even going to talk about the dividend in here. And okay, so after you pay all the HELOC interest, which is going to be 911,000 is what you have left. So let's just see, what did you pay in HELOC interest? 1121 minus 911. I'm just going to round. You have $210,000 that you've paid in 30 years to your home equity line of credit interest. Now, if you have a halfway decent tax professional or an accountant or a CPA, and I'm assuming that $210,000 of HELOC interest that you paid over that 30-year period, you were able to possibly use that as a tax deduction because it's an interest expense. And can you use that interest expense as a tax deduction? I don't know. It depends on what you use the money for. But you probably used it for a business purpose. So you're probably going to be able to deduct that interest. Are you not, from your taxes? And now you're going to pay less in taxes? I don't know. I'm not the tax professional, but I'm telling you, if your tax professional tells you that you can't do that and you really use the money for a business purpose, you may want to consider finding another CPA, tax professional, or tax advisor. But that's for a discussion that you're going to have with them. So my point being is that what did we really do? We put the money in the policy, because remember, ladies and gentlemen, boys and girls, all your wealth, every bit of your wealth has to reside somewhere, does it not? It's either going to reside in the bank of the state you live in. For Chris, it's New York. For me, it's Florida, right? Wherever that you live, you can either have your wealth reside in somebody else's bank, the conventional bank, the bank where all the other people, the profit holders and the shareholders and the stockholders, are going to make the profit off of the money that you leave there. Remember what I read yesterday, page 48 of Nelson's book, right? Page 48, you want your wealth not to just to reside in somebody else's bank. You would rather have your wealth reside in your own banking system, i.e. this IBC policy, this money multiplier, infinite banking policy, the policy that you own the contract on. You have first right to your money. You are in number one position when you want to take a loan out. And on this whole deal that I showed you, we only injected $600,000 of outside money. We have $1.1 million of cash. After we pay the HELOC interest for 30 years, we still have $911,000 of cash. And guess what I'm not showing on this illustration? The death benefit. Who knows what the death benefit is, but you have all that too. And I didn't even show it on here because it was going to take up one more column and it wouldn't fit on one page. So I hope you guys are seeing the power of this. So if you guys have money right now in a home equity line, or maybe you just have equity in your house, all you do is you go down to the bank and ask them to open up a home equity line. Guess what they're going to ask you? They're going to say, hey, Bob, how much is your house worth? And you're going to say X. And they're going to say, how much do you owe on the house? And you're going to tell them. And then they're going to decide what equity they are going to give you in that house. Now, a home equity line of credit, which I'm assuming nobody knows what that is, but a home equity line of credit is like a mortgage on a house. And if you already have a primary mortgage, you can have a second mortgage. It's a home equity line. It's not, okay, so again, it can be opened and closed as you want it. The money can come in, it can come out. When you pay it down, you have that much more to use, right? It's not like your conventional mortgage where if you make a big principal payment, okay, it's not like your payments stop. It's just you owe lower in principal. So very powerful, especially for you guys that are in real estate and you're wanting to move money, or even if you're not, maybe you need to put money into your business. Maybe you need to fund a college education. Maybe you need a new car. Why let that money sit there and go unused? And again, I'll just close it with this. Okay, again, this is not for everybody. This is not for somebody that does not have the proper mindset. It is not for the person that thinks just because they have checks left, there's still money in the bank. You have to be disciplined with this, but you might as well use it because it's there. And I'm just going to guess that mostly around the country, and I don't know if it's everywhere in the country, but most of the country, the real estate prices have been increasing pretty good for the last 12 months. Have they not? I mean, I can tell you this. I bought a piece of property in Island Park, Idaho, and I closed, let's see, Hannah, was that what, July, August? In August. I closed on the property in August. In Island Park, Idaho. It sits on the Wyoming, Montana, Idaho border. It's a great place for snowmobiling in the winter. It's a great place to ride four-wheelers in the summer. I bought a house and I bought the lot next to it because I didn't want someone to build on the next lot. Brand new construction. I paid $532,000 for that property. I was up there about 3 weeks ago snowmobiling, and they told me, they said, Brent, if you want to sell this property today, I'll get you $900,000 all day long. Now, that was pretty appetizing. I paid $532 in August, and here in the month of February, they want to get me $900, but I don't want to sell it because I want to enjoy it and use it. But the reason I bring that up is I think maybe a lot of the country, the real estate prices have been going up, which means you have more equity in your property or your land, which means if you go to a bank and say, Mr. Banker, this is what I owe on my mortgage. If you have a mortgage, but I want to open up a home equity line of credit, how much will you give me? And I would shop it at a couple or a few banks. Throw it back to you, Chris.
Awesome. Awesome. All right, folks. So what we're going to do now is we're going to take a real little break here. We're going to kind of answer just some questions during the break, but we're going to do 15 minutes and we're going to kick that off right now.
say is the root of all evil today. But if you ask for a rise, it's no surprise that they're giving none away. Away.
Yes, absolutely. I certainly was in the right.
An oldie but a goodie, the Pink Floyd, Money. Thought that was an appropriate song to play for today since all we're doing is talking about money. I know we're still on the break, and as soon as we get done with this break, which is going to be about another, I think about 8 minutes, what we're going to do is we're going to start talking about tax benefits and write-offs for your LLC and different things that you can do to actually use this policy in your business and benefit. Now, again, we're not CPAs. We cannot give tax or CPA or legal advice. So you have to consult with your CPA. We have certainly consulted with our CPAs, but it's your due diligence and your, best interest to always make sure that your CPA looks at what you're doing and gives it the good thumbs up. So with that being said, let's see here. What do I got? Another thing too, just before we get into this, because I know people are on break, but what I'm going to do is I'm going to stop sharing. I want to move this over. We're putting up a ton of resources for you folks. So I know the questions are coming in fast and furious. So as they come in, we're putting in, different links, different resources. Although we can't make, any one suggestion on a bank, we do work with some other professionals that do give the equity in your house and that do it in a very unique way with no debt and no monthly payments. The link was just put up for Quantum RE. It may or may not be a fit for you, but it's worth you doing your due diligence, running it by your CPA to see if that could be a good option on how to tap into the equity in your house. A lot of people have, told us that they've been using Quantum RE and they're just thrilled because it's giving them the ability to do something normally they wouldn't be able to do, whether they couldn't qualify at a regular bank or whatever that might be. The other thing too, somebody was asking about the hat that Brent had on, the BYOB hat. So we do have these hats. You can get one of these. They're $19.97 plus shipping. It's we have a couple different colors. We have this one, which is the one Brent had on. It's a New Era, okay? New Era hat. It's the 940 if you guys are keeping track of the type. And it's a dark gray with black mesh. You guys can grab that, $19.97. Just shoot a message over to us and let us know. And again, these shirts that we mentioned. So we got this one here. This is Albert Einstein, the eighth wonder of the world, uninterrupted compound interest. And we got the one that Stephen had on earlier, which is my all-time favorite. And this one is just BYOB, be your own banker. These shirts are also available to anyone who is a member of MSTV. MSTV is our continuity program. Our basically we call it our tribe. They're our peoples. It's where we post all of our training videos, where we post all of the videos, not just about infinite banking, but about everything, 401k, self-directed IRAs, everything that we do that we think is of value when it comes to money and your financial future is put on MSTV. And we do a lot of other things. There's so much content in that platform. And we also have a private Facebook group that's available only to MSTV members. It's $19 a month. You guys can do that. We'll put the link up for that. If you're interested in MSTV, you can do a 7-day free trial. Heck, take 7 days, go for a blitz, watch as many of the videos, and maybe you don't even need it if you can get it done in 7 days. But remember, we're always putting new content. But the coolest thing is if you do that, you get one of these shirts for free, and they're limited edition, only available to MSTV members. All right, Brent, as we kind of wrap up this break here, we got some interesting things. There he goes with the hat, and you can see.
Hey, Chris.
Yeah.
So can you explain how if a person is brand new to this and maybe they want to schedule a strategy call with us on our calendar, so maybe they can put that in the chat box, and they can go to our calendars. Do you want to talk about so how they can do that?
Absolutely.
And the thing is, I said earlier, if someone wants to see my specific presentation, the one that I did, and I know Chris has one that he did as well, but all you have to do is email me, Brent@themoneymultiplier.com, and it has the mapping example on there. It has the car example, the downloadable attachments as well. So if somebody has not seen that and they want to see the way that I present it, maybe compared to the way that like how you present it, or if the people have seen me and they haven't seen yours, maybe they want to watch yours as well. So, but anyway, so like with my presentation, just email me, Brent, BRENT @themoneymultiplier.com, and I can send that to you. And also, Chris, I think what we should do, if you haven't done it, I think we should give everybody on our ebook, Mapping Out the Millionaire Mystery, that Chris and I wrote. It's been about a year now that this book has been out. So I'm okay to send that to people as well if they want to email me or however you want to do it.
That's easy, Brent. Let's make that easy. So what we'll do, as you all know, and as you've already gotten, you got the day 1 recordings of yesterday's training. You're going to get the same thing for day 2. So Shauna will just give you a link that gives you the ebook for free. So we'll give this Mapping Out the Millionaire Mystery book to each and every single one of you, just as part of, our thank you to you for being here. And just like Brent was saying, it kind of took us by surprise yesterday. There was a couple chats that came in and people were saying, wow, this is incredible. Who would I call for something like this? And we're kind of just like, wait a second, this is what we do. So if you want to set up a call to talk about your situation, ask your questions. If we don't get your questions out in the chat or the Q&A, we are more than happy to jump on a call. You can schedule right there on the chat. You can see there's 2 links. One is for Brent. The other is for Gabby or Hannah, Gabby or Steven. You can book a call with anyone, just look at the calendar, whoever can see you sooner. It's kind of the same thing, and just ask whatever questions. Our team is not going to sell you anything. We are going to answer your questions. And at the end, you can ask us if we will help you set up your banking policy. It's kind of our culture and our policy to say that we're not here to sell you a policy. We're here to walk you through a process and help you start your banking system, which does not involve basically selling you anything. It involves walking you through the process and helping you get to your end destination. And that is financial freedom and control of your money. So right there, folks, you've got it all, the ebooks right there. You've got the links to set up calls. If you already have a policy, and only if you already have a policy and you need to meet with the mapping team to take a loan or update your map. And again, I'm gonna say this like numero uno, okay? Uno, dos, tres, 3 times. Only if you have a policy already set up, can you book a call with the mapping team? And we'll put the mapping team's contact up there just so you have that as a resource as well. So this next section is a really good one. This is where it's going to be Brent, myself, and Steven's going to jump in on this one, but we're going to really start talking a little bit about some of the tax benefits and some of the ways that we use our policies and receive some favorable tax treatments through our companies. Now, Brent, did you have a video you wanted to play on this one, or do we want to just draw it on the whiteboard?
I don't think I have.
No video.
No video. I have the one where I'm going to talk about starting a policy as like a business. Is that what you want me to talk about now? That's what I'm gonna,
I think we got that one for the key person. So let's just talk a little bit about ways that they can use their policies.
Oh, okay. I got you. Yeah, I could just pull up my illustration.
Correct.
And I can, a policy illustration. So not a video. I'm with you. The key person policy.
Yep. And then what we'll do is we'll come over and we'll use this and kind of do the diagram again, because this is what I want people to get used to, that circle. But let's talk about, that plan that you were just mentioning. Let's share that first.
All right, hold on just a second. Let me pull it.
And yeah, Stephen, I definitely want to bring you into this one too, because I know you've had a ton of experience with this in the business, and you talk to so many people. So, as we get into Brent's illustration here, once he shows that, I definitely want to, talk a little bit about this and some different ideas. And, kind of how I thought this would be is kind of like a lightning round. After Brent shows his presentation, we'll just do a lightning round where it's just going to go around and wait, what's that? Anyone is confused? And okay, sorry about that. And just kind of talk about different ways to use it. There you are.
All right, you got it now, Chris?
I do.
Okay. So
maybe make it just a smidgen bigger if you can expand it just one more.
Expand it more than this?
Oh, no, actually, it looks pretty good. I'm looking at it from an iPad, so it looks good.
Okay. All right. So, for example, so let's say if you have an employee. Now, this is just a policy that I did on myself, but it's just a policy design, and it could be on a key person. When did I do this one? I did this on May 2020. Can you see that up here? May 2020. And this is a $20,000 annual premium with a company that we talked about earlier called One America, AUL. Hang on, Hannah says we got to change something because people can't see it.
It's funny. Some people can. I mean, both of us here on our computers, we can see it perfect. It might just be like an internet thing where their computer's just not uploading it fast enough. But yeah, we'll put the Google link in there. Yeah, no, they're just going to put the Google link up here in just 1 second. So is everybody liking this so far? Yeah, I know. Technology is fun. Everybody having a good time? Everybody learning some good stuff? Because we got a lot more coming up this afternoon to show you too. And I know we've only got, whatever, till 2:30 today, but we're going to jam that 2:30 time frame, and we're going to give you as much information as we possibly can. And we're going to keep it rolling. I'm really excited about 2 things that we're going to show you, which should blow your mind because it blew mine. Yep, Anita, we're working on that. I think what they're doing right now is just getting the Google Doc up so that you guys can all see it, because we want you to see the numbers. It's great that we talk about it, but it's better when you can actually hear it and see it, because a picture's worth 1,000 words. Yes, Larry, thank you. I think that's exactly what's happening. I'd like to take a poll to see if it's all the Mac users who are having trouble seeing it. Just kidding. Just kidding. I love Apple. I'm just always harping on you a little bit about that.
It's the internet quality. Sometimes if your internet connection gets weird, Zoom will reduce your quality and it can make it blurry.
Oh, that Zoom. I think he's got it.
Chris, you got that now?
I mean, it looks good on mine, but the whole thing did look good. It looks good before.
Okay.
I know Macs are fine. I love Macs. I'm actually going to be buying one.
All right. So anyway, let's just try this. Okay. And again, it's just a policy illustration. So if you want to buy a policy on an individual, let's say you have somebody that's an employee and you want to offer them a benefit. Like a lot of employers will say, hey, how about contributing into this 401k IRA, this qualified plan here? And of course, a lot of people don't want to do that because it can go up or down. Well, instead, how about giving them the benefit of you purchasing a life insurance policy on them? Okay. So the thing that they have to do is they have to agree to allow you to own a policy on them, but it's going to be you paying it just for them. And then you're going to give them X amount of money at retirement age. Okay. So the policy is paid for by you. It's owned by you. Remember, there's 3 things on every policy. There's the owner, the insured individual, and the beneficiary. The owner is the one that controls everything that goes on in the policy. The beneficiary is probably going to be the same as the owner in this case, because the owner is paying for it for a key person or an employee, and the insured is that individual. Well, the owner and the beneficiary can change at any time. So in this example, and I'm just going to use a policy illustration that I have on myself, and this one I think I did a couple years ago in 2019. I mean, it's all math, right? It's all the same. Math doesn't necessarily change. But so like in this example, the thing we're going to do is we're going to put in $10,000 into a policy. So let's just say Brent Kessler is my employee, right? And I'm going to put in $10,000 into the policy. Well, I'm the owner, and the employee is just going to be this person. So I'm going to contribute X amount of dollars to this policy, and I'm going to own it. But the thing I'm going to give them as a benefit is I'm going to give them X amount of money at retirement age when they retire. And I'm just going to say age 70 is retirement age, okay? Not 65. I mean, again, it's okay if you want to say 65 or you want to say 70. Okay, but in this case, what we'll do, we'll go to age 70. So this is an employee that's starting with me at age 52. So it's kind of an older employee. Probably most of your employees are going to start with you younger than age. Well, I don't know. I shouldn't say that. I don't really know. Maybe older, maybe younger. But in this case, the person is starting at age 52. And we say, hey, as long as you allow me to own a policy on you, I'm going to give you X amount of money in retirement age when you hit age 70. And you may want to put a stipulation in there and say, hey, as long as you stay with me for X amount of time, maybe it's 2 years, 3 years, or 5 years. And if you don't stay with me, then I'm not going to give you that retirement income. So it creates your employees being.
That's not good. We lost audio. You guys froze.
Can you hear me, Chris?
Yeah, but it's weird. Did something happen to your Wi-Fi?
Oh,
Oh, wow, that's weird.
all right.
Is his computer hardwired in, or is it just Wi-Fi?
No, it's just Wi-Fi. He's live though now.
Okay, there you go. There you go. We're good.
All right, is that better? I don't know why you lost audio, but is that good now? Okay, Chris, can you hear me?
I can. Yeah, you're good now.
Okay, good deal. Okay, all right. So anyway, this individual at age 52, the thing we do is just buy a policy on them, and it's going to be $10,000 a year. We're the owner of the policy, so we can control it. We are controlling the policy, all of the banking functions, everything that goes in on it. So now, okay, the thing we're going to say is that this person is going to retire now at age 70. And the thing that we're telling them, and again, it can be set up however you want, but the way that I did it is I said, here's what I'm going to do. At retirement age or age 70, I'm going to pay you X amount of dollars for 10 years. Okay. I'm going to pay you X amount of dollars for 10 years. And let's just say that I'm going to pay them, let's just say I'm going to pay them $10,000 a year for 10 years. Okay. And okay, so like in this case, the thing is that I'm giving them a $100,000 benefit, basically, right? So 10 years, I'm going to give them a $100,000 benefit. Well, so keep in mind, this is just the raw illustration of the policy. That's all it is the raw illustration of the policy. And this is not costing the employee anything. So if they start, all right, so like if I start giving them, and again, I said 10,000, I should have said 5,000. I'm going to give them $5,000 a year or $400 a month, essentially as a retirement benefit for 10 years. So $50,000 over the next 10 years. So on this policy, if you notice here, and again, I'll just go to age 20, or I'll go to year 20, age 71. If you notice, I put in $4,000 into that policy this year. And the policy grows from 144 to 153. So it's like a $9,000 growth. I put in 4 and it grows from 144 to 153. If you see it here under total net cash value. So is it okay to give that employee a $5,000 annual benefit, right? As far as retirement income. I'm not saying it has to be 5. It could be lower, it could be higher. I'm just going to use 5,000 in this example. So, because remember, the employee didn't put in anything. So absolutely it is, because I put in 4 and it grows by 9. So if I put in 4 and it grows by 9, okay, it's growing 5,000 more than I put into it. Well, so is it really costing me anything this year to give that $5,000 benefit? No, it's not. And also keep in mind that this policy is 19 or 20 years old. So I'm already starting out with at least $136,000 of cash value in their retirement account that I set up for them, that I own and control, right? So I could give them more money per year if I want, but I'm just saying $5,000 a year. So I'm going to do that for 10 years. And okay, so as you notice, these numbers continue to go up each and every year, right? It goes up, it grows by 9, it grows by 10, right? It continues to grow by at least $10,000 every single year that I put $4,000 into it. So it means I can pay them the retirement income of $5,000 that I promised, okay? So now at the end of the policy, I no longer owe them retirement income, but I still own the policy, okay? So basically I committed to giving them $50,000 of, I've committed to giving them a total of like $50,000 over 10 years, and it didn't cost them anything. Or if they pass away before the 10 years is up, let's say they pass away between year age 70 and 80, then I will pay that retirement income, in this case, $50,000, I will pay their beneficiaries that outright for any amount that they have not collected. Well, can I do that? Absolutely, I can, because I have $300,000 in a death benefit that I'm going to be getting. So can I afford to pay them 50? I actually can. So essentially the thing that I've done is I've just opened up a policy on an employee. Okay, I own it, I control it, and I'm going to give them this benefit at retirement age. Now, it doesn't have to be $5,000 a year. It could be $10,000 a year, because I have the money to do it. But I am always going to own the policy. I will always own it. And then the policy will end when that employee passes away. When they die, the death benefit, wherever it is that they pass away, the death benefit will now be paid to me, okay? And so I will get the death benefit, and I'll get that minus any loans that I've taken out of the policy. So I've owned the policy the whole time. I put this benefit in place for this particular employee, okay? And if so like if you are starting earlier on someone that's younger, and if you do another premium amount, then the dollars may be bigger. So what you got to do is, on your policy illustration, is you have to look at the illustration and you have to see what is the growth on that year that you're telling them that you're going to give them when they retire. Okay. I mean, again, for me, it's like 70, but it could be 65. It could be 75. And if they die ahead of time, we're going to pay their beneficiaries the number. So even if they don't make it, then, okay, whoever their family is, they're going to get paid those dollars. And the thing you can do is go one step further, because what you're doing, you're giving them that as retirement income. So the thing you can do is write them a check for that. And that could be a taxable event for them if you choose to do it that way. So what you can tell them, hey, I'm going to give you, $5,000 a year, $50,000 over the next 10 years. But that's going to be pre-tax money. And then obviously you can have a tax deduction as well because you're giving them money, and then it's considered part of your payroll or the overhead of your business, and you should be able to deduct that as a payroll expense or a benefit expense that helps put you in a better tax situation. So again, all of this is infinite. It's however you want to structure it and however you want to design it. But a lot of people own policies on their key people or their employees.
2 questions. Should the policy be owned personally or by the company?
2 questions, Hannah says. Question number 1.
That's just one.
Okay, hang on. Question number 1, should the policy be owned by the business or should it be owned by you personally? Well, again, it's completely up to you who's going to own the policy. I mean, I don't like a corporation or a business to own any policies because they're appreciating assets. And if an LLC owns an appreciating asset and the LLC gets sued, then that could be part of the judgment. So I like to either own the policies individually, or in your own private family financing company, or even have the trust own the policy. So that's my preference. What's question 2?
What happens to the policy if the employee leaves before retirement?
What happens if the employee leaves before retirement? Well, that's why I said earlier that you decide what that criteria is going to be for them to create the benefit. But even if the employee leaves, and even if they're going to receive no benefit, the policy is still owned by you. I mean, look, guys, I mean, I owned 5 chiropractic clinics in the Kansas City area. I had a lot of my associate doctors insured. Well, I don't own any of those clinics anymore, and I don't have any of those as employees or on my payroll. I've sold those clinics. A lot of those policies or of those clinics I sold to the doctors that are in those clinics. I still own the policy. So even if somebody didn't like me, all right, so even if they were mad at me now and they're like, I don't want Brent owning a policy on me. Well, tough beans, man, it doesn't change. The owner controls the policy. He or she who has the gold makes all the rules. So even though I no longer have anything to do with them anymore, I still own the policies. I still own the policies on their lives. And as long as they're living, the numbers continue to come up. It's not an if, it's a when they die, then my family or my estate will get the death benefit. It'll be minus just like anything that I have agreed to pay them in the policies that I own in them. Chris, throw it back to you, man.
All right, man. Sounds good. So what I'm going to do actually is, if you want to stop sharing, I'm going to bring my screen up. And Stephen, if you can turn your video on as well. And what we're going to do is I just want to kind of walk through a few of these examples. Like this is the one that Brent was talking about. I was kind of just writing it out on the board, you know, in that example, if Brent was the owner or Brent's company was the owner, and then the insured, which can never change, was that key employee. And then the beneficiary more than likely is Brent's company, but maybe, you know, like he said, 50,000 is the key employee's family. And you can structure these because they're non-qualified any which way you want. You know, and in this case, he's putting 10 in. At any time, remember, who was the owner? The owner was Brent or Brent's company. At any time, Brent was in control of all of that cash value. So let's just say his business needed money for marketing. Let's say he wanted to do a big marketing campaign and he wanted to do a big social media push and he wanted to take out $10,000 for this marketing campaign. Because he owns the policy, even though he's not the insured, can he take that money out? Sure he can. If he owned it personally, the money would stop off here in a segregated account and he would loan it. If he owned it with his corporation, he could just go right to his corporate bank account, skip the loan. But the cool thing is if he owns this personally, what that gives him the ability to do, let's draw a line right here. This side's personal. This policy, if he owned it personally, what he can do is lend money to his company and he could charge himself 8%. So he could take and structure a note for $10,000 for 12 months at an interest payment of whatever, I don't know, $910 a month if he wanted. And he can, remember, I'm just using numbers. This number could be anything. Heck, he could say, well, you know what? I'm going to do it for 60 months. because I only want my monthly payment to be 210. I'm just making stuff up. But his company then just makes bill pay, just like Devin did. He sets up a bill pay to pay back that $210. Now, I want to ask everybody a question. If this was straight interest, if this was an interest-only loan, can Brent's company, which took a loan from Brent personally with a note, okay, because remember, there's got to be a note. So he's got a note. Brent personally lent money to his company. Can he write off the interest? Does anyone know the answer? If it's structured properly, Brent can write off the interest because it's interest expense. So over here, he picks up another expense called interest expense for his company. And this $210, whose account is that going to make it back in? Last time I checked, this is Brent's account, Brent's segregated account. And then if Brent wants, can Brent send that $210 back to the policy to have the policy regenerate and build itself back up? Sure. And he can just keep doing this over and over and over again, and basically making, getting tax write-offs. Now, some people would say, yeah, but then Brent has to pay tax on this 210. Indeed, he does. This is income to Brent because he's paying, his company is paying him interest on the loan. So that's income to him, a write-off to his company. So in the perfect day, that's a complete wash. Now that's still a win if that's all he did, if it was a complete wash. But most of you have a good CPA. Most of you know how business works. Can you get a little bit more in write-offs over here in a business than you can personally? Like, do you think there's more write-offs available to a business, an entity, an LLC, S Corp, C Corp, than there is to you personally if you're just kind of just doing things individually as a W-2? Well, yeah, of course. That's why businesses are the answer, right, Stephen? Like, I mean, you've dealt with this a lot. I mean, with a business or a W-2, I mean, why is it that W-2 employees constantly get screwed when it comes to the interest or the taxes they got to pay? What would be the reason for that?
Okay. What do you mean by get screwed?
Well, like, think about it. Like, a W-2 employee doesn't have a whole lot of options, for write-offs. There's only so many things they can write off. But a business, pretty much, it's kind of, there's tons of different things that a business can write off that an individual cannot. So if you were just making a W-2 income versus somebody that was a business owner, or maybe somebody that was making W-2 income but then had a business, like, can they pick up additional write-offs with the LLC?
Yeah, if you have an extra, as long as you have a business started and you're actively working a business, you're going to be able to open up all those write-offs, big time. That's what we always recommend during our Money School 3-day training. Like, get a company started, get an LLC going, and it's going to open up the door for write-offs. I mean, you can start writing off your vehicles, the miles that you drive, your home office, all these different things. Now, again, talk to a CPA about what's right. I mean, some will recommend not writing off some of that stuff, but focusing on others, not to raise flags and whatnot. But it's just the way the system's set up, right? It's like everything that we teach. Solving the money problem, which, according to the Social Security Administration, less than 95% of people are not going to be able to retire the way that they want to. So only 5% are. So everyone has, so that tells me 95% of people have a money problem, right? And then it boils down to taking control of your money. So right now, everybody pays everybody else first. So your money's going to credit card companies and go to this bill and that bill and your mortgage and, going out to eat and all this stuff, but not many people pay themselves first. So number one, that's one thing we talk about, pay yourself first. And, with these policies, you do that through recycling, recapturing that money, that interest that you'd be given to somebody else. So you're already paying yourself, through the use of the policy. And then it's just the way that the country's set up. I mean, we're put through college to go learn how to do a job, go work for somebody else. We're told to invest in our 401k. Well, who benefits truly from a 401k? We don't, because, crashes, you lose all your money anyways. Nobody can actually retire the way they want to using a 401k. So what's the real point of it? It's to get money into the stock market, into the financial systems. So these guys, these hedge funds and these fund managers can make billions and billions of dollars. And then when they lose, guess what happens? They get bailed out through your tax dollars. So you get screwed every which way to Sunday, right? And it's the way the country's set up. It's the way that life is. Unless you're willing to learn to do something different, which every one of you on this right now, that's why you're here, I'm assuming, right? Because there's something better out there and you want to learn what it is. And that's exactly what we're teaching. So start that company, take advantage of these tax write-offs that way. Learn what we're teaching you with this. And when you have partners, when you have key employees, learn how to keep them with you. You know how to not jump off the street. I mean, if somebody gives you a better offer, maybe in another company, but you're like, man, I got $1 million insurance policy over here, maybe I'll stay there. And, and so there's so many reasons to do this. And does that kind of help answer the question?
Yeah. And then if you don't mind, let's do some lightning round. Like, and Brent, if you want to jump in on this, if this is like how the money moves, we've seen this enough times. You guys should be getting used to this by now. Everybody watching this should kind of know that this is a circle. So I don't know. Let's think of a bit. How about a dentist? Okay. So let's pick on a dentist. I don't know why, just because not many people like going to the dentist, but dentists do quite well. So what is it, if you were a dentist and you had a dental practice or you were just opening one, what do you think one of the biggest expenses for a dentist to open a dental practice would be? What do you think they need to buy?
X-ray.
Yeah. Okay. So they need X-ray equipment. What else?
All those, so like chairs and,
The waiting room stuff.
yeah. Well, no, I was talking about the big dental chairs, that they have to have.
Okay.
I think Shauna said it best, all the shit inside the facility.
Yeah,
Okay,
absolutely.
So all the shit. I like that. So we'll just write that. That kind of covers it all. I think, does anyone have anything else outside of all the shit? Because I think we got it all.
Yeah. Well, anyway, also their malpractice insurance is not cheap.
Yeah. Insurance, magazine subscription, that goes under all the shit though. So I think we got it all.
And also they have to acquire the building. They either got to pay for the building or they have to pay the rent.
That's a big expense.
Or what a lot of dentists do though is they lease their buildings, don't they? They lease their building from someone else.
That's right.
Okay.
So either they rent or they buy the building. And then also a big expense is the employees, because it just can't be one person in the dentist office. The dentist, they need a dental hygienist. They need someone at the front desk. They need someone to schedule the appointment. So payroll.
They need about 10 people to deal with the insurance companies.
Yeah.
Amen.
So when a dentist is thinking about opening a practice, that's a lot of expenses. And, a lot of times they borrow money from where do they get all the money? Like the $1 million or $2 million or $3 million that they need. Where do they go for that?
Hey, Chris, can you pin yourself again?
Yep. Sorry, folks. I know everybody wants to see the board. There we go. So where would everybody get, a dentist? Where would he get the money for that?
Well, it's hard because a lot of times the thing is that they come out of school and they've got hundreds of thousands of dollars in student loans, and a bank doesn't want to loan you the money. So a lot of times the dentist has to go in to work with someone to an existing practice if they don't have the funds to start their own office. But yeah, so
okay, so if they did come out of college and they were financeable, they could get bank financing, and at that point they're giving interest to somebody else's bank. They could borrow private money, or they could save up the money to buy all this stuff, right? And many of them, this is what they do. They go to work for someone else. They save and they save and they save to buy all this equipment. But, I think we know a better way, don't we? I really think we got a much better way. I think a couple things could happen here. The dentist, with this money that they were saving up, they could change where that money goes and they could put it into this policy here. So let's just say this is Dr. Smith. We'll just use a big name, okay? Dr. Smith is the doctor, and he's personally opens up a policy, and let's just say he's going to save $100,000 a year. Now, I know that sounds like a lot. I'm just making an easy math number. Starts to save $100,000. Gets ready to open his practice. At that point, he saved this money up for a couple of years. Let's just say we've got $500,000 in cash value, and he's going to use that money to go out there and finance or buy some of the stuff. Maybe he can't do it all now, but let's just say he just took the things that he could do with 500, all the shit, the equipment, the chairs, the X-ray, the insurance. So, he does all this. The only thing he's not going to do in the beginning is the building. Okay. And he's going to leave a little bit of a float for the employees. So if he takes a loan, and let's just keep the math simple, takes $500,000 personally, takes the loan. Now he's going to pay 4 to 5%. So now his segregated account's got $500K. And then what he does is he has his attorney draft up this note. But he says, when I went to the bank and asked them about financing this. And when I went to the hard money lender was trying to charge me 10%. There was this guy, Brent Kessler, that I went to borrow some money to start this dental practice. And man, that guy wanted to charge me 10 to 12%. So I went to the regular bank, and the regular bank was only wanted to charge me 8%. So I told Brent to go pound salt, and I'm just going to go to the regular bank. So the dentist says, if the regular bank was going to charge 8%, well, why wouldn't I charge myself 8%? But then the dentist says, well, I got cash flow issues. This is a new business. So I want to be very careful on how much money I commit to pay myself back, because if my business doesn't do well, I want to have flexibility. Well, with this, when you do a note from your bank to your business, okay, you're in full control, right? So you could say, well, I'm going to do this loan, and I'm going to do this loan I'm going to do 15 years. I'm going to do a $500,000 note for 15 years, and I'm going to charge 8%. And that's going to make my payment only, I don't know, let's call it $600, because he or she knows that they can pay $600. And if for some reason there's a month that gets tough and they can't make that 600, what happens? Well, the dentist looks at themselves in the mirror and says, okay, banker Smith, I'm having a hard time. I need a break. I need a couple months off of this $600 payment. Now on the other side of the mirror, okay, looking back is banker Smith. And banker says, well, you've been a good payer. I do kind of like you, and I like these checks. So yeah, you can take 3 months off, no problem. Dentist Smith says, thanks very much. You're literally the bank. You're talking to yourself. So you can structure these terms any which way you want on this. So that happened is the dentist loaned $500,000 to his company. So he uses his $500K, he buys the x-ray, the chairs, the equipment, he buys all the shit, pays for the insurance, has a reserve for the employees, and all he's doing is writing a $600 a month check back to his segregated account here. And what we're going to do is we're not going to put the money back in the policy yet. He's going to take this 600 and he's going to build it up while he builds up his policy over here, because he's still putting $100,000 a year, and he's eventually going to then buy a building. So let's just fast forward, okay? A couple of years, he's in practice, doing well. Now has about not 500,000 anymore. Okay, now we've got $1 million that's in the policy. And you've seen enough policies to see it doesn't take all that long when you're doing that. But then this 600, let's just say that built to $30,000 in the segregated account. So now we got 1.3 million that we're going to basically be able to use here. Following the math. I'm just making numbers up as I go on the fly. So Dr. Smith says, you know what? I'm sick of paying monthly rent checks to my landlord. My landlord's a jerk, never fixes anything. The toilet's always backing up. The roof's leaking. True story. The roof's always leaking here. But you get mad at your landlord, and you finally said, I'm going to go buy a building. So let's just say Dr. Smith takes this $1.3 million in here and personally goes out and buys a medical practice, like buys a beautiful building, puts a little awning on it, and puts Dr. Smith Dental, Dr. Dental. Okay, opens it up, boom, we got that. So now he's open for business, ready to go. So he's got this new building that his policy and he personally bought, but he needs the building for his business. So he could rent from himself personally. But what he then does is he just says, well, you know what I'm going to do? I'm going to lease this personally owned building to the company. Or he could even open up a separate LLC, or could open up a trust in which this separate LLC and trust owns the building and then leases it to this other company, the dental practice company. And then he's making lease payments back to himself. So he's literally leasing the building. Now, does anyone know what happened here? So number one, the dentist, instead of using somebody else's bank, instead of using Brent's money, he saved up and he then became the bank, and he was able to buy all the equipment, finance it through his own bank, but then eventually bought a building, leased the building to his company because his company needs write-offs. He's through COVID. He's doing lots of cleaning. He's doing lots of crowns. He even got into those, what do you call those things where they put all new teeth in your mouth? Like got into that. He's making a ton of money. And now his company needs write-offs. So this lease payment of $2,000 a month, that's a write-off. Okay, the $600 a month that he was doing here, that's a write-off because that's or just that's all interest, let's just say, or some of that's interest. So he created a write-off, but yet he's still getting 100% of the money that he used to give away. Just another way to look at it, just another way to use it. So Stephen or Brent, what other examples could we give while we're doing these?
Yeah, I mean, anybody that owns a business, anybody, I mean, you could even do it as an investor, putting into properties, like, right? So you're buying real estate properties. In that example, it was just a dentist, and the guy owned a dental practice. I mean, it could be an MD, it could be a chiropractic equipment, somebody investing into Airbnbs, VRBNOs.
That's a big thing now.
Yeah, you know, or like if you own like a company, a business, you know, my in-laws, they owned a printing and publishing company. They owned a, you know, so anyway, they owned okay, it's like a cemetery and a mausoleum. So any expense that you have that's related to the business, you want to be able to recapture and recycle those dollars and keep that money under your own control in your own family.
Stephen, any other ways you can think of to use it from a tax standpoint?
I mean, no, you guys are hitting it spot on. I mean, it's, you know, it's something that, you know, all of us should look at doing is saving in taxes. I mean, we just, you know, just as an example, you know, I'm all for taxes and helping other people, but I mean, when they pass $1.9 trillion spending bills that we don't even have that much taxes to pay for and stuff like that, and it's not COVID relief at that point, it goes everywhere else. I'd rather save my money and take that and put it to actual good uses that I know it's actually going to truly help people, as opposed to all this pork and crap that happens with our government. So, you know, I'm all for helping other people, but I'd rather control that money, take back control of that money, and use it within my local community or some of my other favorite charities, and where I know it's going to directly help people. So anytime I can find a strategy to help on saving through taxes and not giving as much to the government and controlling that money, I'm going to be all over it. So, you know, and that's why we implement companies. That's why we implement these strategies within our companies, is purely to save so we can do better overall for the community, local and otherwise. And that's my thing. I mean,
absolutely.
Yeah. Okay. Well, Chris, keep in mind the presentation we did yesterday. Okay. So even the taxes they do have to pay, of course, nobody likes to pay taxes, but yes, we do have to pay them. But even the taxes they do pay. So remember the example we gave yesterday of how all the money you pay in taxes, that money comes back to you anyway. If you set up that policy and you just use it for your tax liability that you have every year. And the example that we gave yesterday was somebody that had a $100,000 annual tax liability that they had to pay. So even if you do have to pay that, if you're running it through this system, you can get all the money back for the taxes that you pay.
Yeah, that actually brings up a unique thing. There's a case study we did with Gary Proctor. It's a really good one. And we basically did almost that, but in a business standpoint. So Gary, and I'm just going to pull up his little thing here. Gary had a big problem with his, and you guys can watch this on YouTube again. It's another case study, but he owns a lot of rentals. And every year he gets property taxes. Here in New York, we are taxed to death. So his property taxes are through the roof, like $34,000. And he would get those property tax bills and he would just pile them up, like, and just not pay them because it's a hard hit. Like twice a year, we get hit with these massive piles of tax bills. And then he said, well, what if I started using this to do that, to pay his taxes? Because he was already escrowing the money. And you guys really don't need to see the board too much. I know some people are going to ask me to unpin or to pin this, but all he did is he just changed where his money was being held. He used to escrow the money either at a bank or in his own business checking account. And all he did is he escrowed his money in Gary's bank account. Okay. Not Gary's bank account. I'm sorry, Gary's private bank. And then he moved that money around the circle. And we called it round the world for him. But he basically took loans and he then loaned the money to his company at 8%. And then he made the tax payments and his company then paid him back at 8%. And he came up with the 8% number because that's what it would have cost him to borrow from one of his commercial lines of credit. And the other thing Gary said, he says, I never added it up, but if I took all the penalties and late fees that I got charged on paying my property taxes late, it's probably a heck of a lot more than 8%. So he said, I'd rather pay myself that 8% than pay, the property tax assessor or, somebody else instead of himself. And that's all he did. And he just did that. That's another business use. Plus, he was able to write the interest off to his company and benefit on that level. So he was helping his company, from a tax standpoint. Again, can't give tax advice, but that's just showing you how somebody else used it. Now, we had some questions, guys, if you want to answer some of these. One of the questions was in that one example that Brent gave with the key employee, where you pay a death benefit to the key employee. Somebody was asking, is that taxable income to that employee's beneficiary?
Well, okay, I'm not sure what the question means. Is it taxable income on the death benefit, or is okay, the dollars that we're paying the employee? Like in that example, we're paying them $50,000, right? So if you or the business is going to deduct that $50,000 as an expense, then yeah, you're going to have to give that employee a 1099 form, right?
Right.
Or else it's you can't deduct it. But if for some reason you don't plan on just doing that, and if you plan on just saying here's 50,000 of tax-free money to you, then you're just giving them a check for 50,000 or however you've done it over the time, then it's not going to be tax deductible for you, right? They're getting it as a benefit, as a gift. It's just like your 401k money that you put in for the employee. Is that money taxable? Yeah, it is, right? I mean, somebody's got to pay tax on the money. So it's either going to be you or it's going to be them. So it's however you decide to do it, however you, structure it.
Most of the time, you're gonna do the 1099 and they're gonna pay the taxes because it's typically looked at as a bonus or as income, part of their income plan or part of their overall commission schedule structure. So typically that's gonna be passed on. So that way, as the business owner, is tax deductible for you. That's gonna be the most common use for it.
Yeah, and one thing people are always asking with the key policy ones, and we're gonna really talk about key policies, and we're going to talk about how we got the idea right from the bank. And all of you have walked in and you've seen the banker. So when I do that presentation, I'll have my little badge on, the vice president thing, but we'll talk about that. One of the things you got to understand is when, you can own it personally or you can own it in the company name. But the one thing I will tell everybody is remember, you want to a lot of people want to write the premium deposits off. And I would highly suggest that you do not do that. Because if you take a write-off on the money that you're putting into the policy, the death benefit and the cash value is potentially taxable. Always think of it just like a Roth IRA. You understand, you put the money in after tax and it's all tax-free. Would you rather put the money in after tax today by today's tax dollars and have it all tax-free later, or would you rather pay tax on it all? But wait, most people that have 401ks, they like paying tax on all of the money. So that's like paying tax on the harvest, not the seed, but I want to pay tax on the seed. So if I don't write off the premium deposits on the premiums I'm putting in, then I get the fruits of my labor all for free. I pay tax on the seed, which is the deposit. So always remember that. The death benefit in most cases, because it's a direct beneficiary, is paid tax, there's no tax on it, it's tax-free. Now there's exceptions to that, and I want to be clear that transparent that you can screw that up, but in business use, usually the beneficiaries are going to be named out. Even if the owner is the LLC, the insured is your key employee, and the beneficiary is your LLC and the key employee's family, spouse. That's all tax-free if done properly. So I think somebody had that question: is the money paid out tax-free or is it taxable? And Pat, this is an important one. A lot of people, when you do this for employees, the key employee thing, everybody's like worried. Well, if the employee leaves, like what happens? If they leave. If you have a vesting schedule, you can stop paying into that. And then if they die later and you're the owner and the beneficiary, you absolutely can go claim that death benefit. 100%. You have a full agreement, and you always want to layer on one thing. Remember, we're always talking legal. We can't give legal advice. It's all with your attorney. But one thing that you would always want to do is structure some type of an agreement with the employee. If you're going to do that structure we talked about, then do a legal agreement with your employee so they understand after X amount of time being with me, I'm going to pay an income, like Brent said, up to $50,000 every month. We're going to give you X amount, or every year we're going to give you X amount, up to this point. But you have to work here for 10 years before you're even eligible for that. And if you leave in that 10 years, it was nice knowing you, the policy's ours. We funded it. We control it. It's non-qualified. It's so neat when you get outside of the realm of all the, the 401ks, which are all qualified money with tons of rules, right, Stephen? I mean, qualified plans have more rules, and I think they could write a whole tax code just on the rules on 401ks and employer-sponsored retirement plans.
So anyway, I would never tell anybody to write the premium deposits off. Remember, the thing we taught Chris is the opposite. The thing you want to do is pay tax on your money. Just pay it one time only, at the lowest rate possible. And you want to get that money into a tax-free environment. And the thing you want to do is get the government completely out of your hair. So premiums are paid with after-tax dollars, which is a great thing. Because now it's in a tax-free environment where it's growing tax-free. So don't try to write off premium deposits. Have you ever heard the saying that like the pigs get fat and hogs get slaughtered? All right. It's all right to become a pig in all of this, but don't be a hog because you'll get slaughtered. So, all right. So yes, pay your tax, but just pay your part of the tax. Pay your tax at the lowest rate possible and get that money into a tax-free environment.
Yeah, I mean, it's like what I tell people all the time, because when you apply for a policy, right, you have to qualify for it and get approved. And part of that's medical, but there's a small part that's also income based, right? So that's why if you make 50 grand a year, you can't put $1 million a year into a policy, right? So there's income requirements. And I always tell people when they apply, make yourself big, include all your income, make yourself, include everything you have coming in. So that way you don't have any income qualification. It's not like taxes where we make ourselves look as small as possible, right? And that's why we have companies set up. That's why we have good CPAs, because we want to make ourselves look like we don't make a lot of money so we can pay less, right? But with policies, you want to make yourself look big so you never run into issues with putting more and more money into policies. And that's all legal, right? We're working legally within the system, but it's the system that we play in. So,
absolutely. Right. Well, we could go on and on about that, but I want to move on to another topic. Stephen, thank you so much for participating. I can't wait till our last session where we really dive into IRAs, solo Ks, 401ks. We'll wrap up with that. Brent, real quick, like me and you, on the green room, we're talking a little bit about, how to actually, how to compare a business and the policy. You wanted me to draw some things like
yeah.
You want to do that?
Good. Okay. Yep. On the board. So everybody just needs to see the board and they'll hear our voice.
And you need to
go.
So I guess you pin Chris or whatever all that crap means. I don't know what it means, but you know what to do.
You just
all right.
Tell me what to do and I'll start drawing away.
Okay. So hang on. I got to take a drink because this is going to be good. All right. So I want you to think of the policy. Every policy that you buy is like starting a business from scratch. So,
all right, Chris, you're not pinned.
I actually just pinned it. That's weird. Okay, hang on. Now I'll do it again. There we go.
All right.
Remove all pinned videos. Is that better?
Yeah, well, it's good for me.
Yeah, that's good.
Yes, that's better. Yep.
Okay, wonderful. Sorry, I thought I did that last time. Okay. So
okay.
Go back to the policy is like a.
Yep. So every policy that you start is like starting a brand new business from scratch. So I'm going to walk you through starting a new business from scratch. And so I want you to tell me after I'm done talking about this, how many of these businesses would you like to own? So the thing we're going to say is hypothetically, the thing that we're going to do is we're going to start a brand new business this year. It's a brand new business. We're just going to open the doors. And in the very first year, the thing we're going to do in that business is put in $1. We're going to put in $1 in the business in the first year. And we're going to pay all of the employees, all of the overhead inside of the business. Everything's going to get paid for. But the end of the first year, all we have to use is 50 cents of that dollar. Okay? So that's year one, new business. We put in $1. Everything gets paid. And at the end of the year, we only have 50 cents to use. All right. So probably what you're thinking is like, okay, well, it's a brand new business. I started it and I knew I wasn't going to get all my money back the very first year because it's brand new. It takes a business a while to build, doesn't it? So now in year 2, we're going to do the same exact thing, Chris. We're going to put another dollar into that business in year 2. So that's our contribution. That's our investment we're putting into the business. We're putting those dollars into the business because it's got to continue to run. And everything gets paid just like in year 1, the employees, the overhead, the rent, whatever it is that you have. But at the end of the year, after paying for that, all you have is 60 cents. At the end of the year, you can only use 60 cents of the dollar you put in. So you put $1 in, you paid everything, and you got 60 cents to use. You're thinking, well, it's still a new business and it's going up. It's going in the right direction. Not where I want to be, but it's going in the right direction. In year 3, you do the same thing. You put in $1, pay all the overhead, and then at the end of that year, you've got 75 cents to use. Okay? All right. So again, we're going in the right direction, but not where we want to be. In year 4, we put in $1 into the business, pay all the overhead, the employees, the rent. And in year 4, we've got 95 cents to use out of that $1. We put in the $1, we paid everything, and we got 95 cents. We're pretty close to breaking even. Okay. Now, in year 5, we do the same thing. We put in $1 into the business. And now for every $1 we put in, we've got $1.05 to use. $1.05. We paid all the expense, all the overhead.
That's every business.
All right. Now let's just go. Let's just fast forward to year. I don't know. Well, no, that's fine. Let's just go to year 6. And I'll basically use it from our map, the mapping example, the end of year 5, beginning of year 6. Now we put in $1, pay all the overhead, all the expenses, and we have $1.30 to use. Now you're thinking, man, this is really humming along. You know, I got 30% more than what I put in. Now, listen, guys, don't get hung up on the numbers. This could be 5 cents more or 5 cents less or whatever. But here's the, okay, so here's the point. And then Chris.
I'm listening.
Chris, so,
Yep.
okay, so like after year 6, every time you put in $1, those numbers are just going to keep getting bigger, are going to get larger. It'll go to $1.40, $1.50, $2, $2.50, $3, $4, right? It just keeps going up and up and up. Year 10, year 15, year 20, those numbers just start getting astronomical. So how much were we getting in a policy that you showed on the like on the 11th year? We put in $1 and got $2.09 or something like that. I forget what the number was. So on the 10th or the 11th year, you put in $1 and you get $2.09, right? Right. Okay. So the numbers just keep getting bigger. Yeah. So if that was really true, and if you absolutely knew 100% that this is how your business was going to perform, and it was guaranteed, no ifs, ands, or buts about it. It doesn't matter what is going on in the external world. It doesn't matter if you have a Republican president, a Democratic president, if there's COVID, if there's no COVID, if there's protests and riots, no protest and riots. And so like, it doesn't matter if the stock market goes up or down, the real estate market goes up or down. All this is based on a true guarantee. Doesn't matter what else in the world would happen. If this is really, really true and your business would actually perform this way, how many of these businesses, here's my question, Here's my question to all of you. How many of these businesses would you want to own? I would think the answer would be as many as I possibly can have. Is there anybody that would not want to own as many of these businesses as possible? If there is, then you guys might not need financial counseling. You may need severe psychiatric care. This is what a life insurance policy is. This is exactly what we're doing. We're starting a business from scratch, and this is what is guaranteed that's going to happen. But the cool thing about this business is what? It doesn't require you to go into it. It doesn't require you to oversee it and manage it. Yeah, all right. So maybe like 15 or 20 minutes a quarter, you're going to look at it. It doesn't. All right. So like it doesn't have employees that are calling in sick. It doesn't have people bitching and whining that they're working too hard or they need more vacation. It doesn't. Okay. And so like the grass doesn't have to be cut. The air conditioner doesn't go out. Right. There's no building to buy. Right. And so let's just say this business just goes down. Let's just say in the first 3 years, for example, let's say in the second or the third year, the business goes down. Well, how much did you put in year one? You put in $1 and you got only 50 cents back. In year two, you put in $1 where you got 60 cents back. So through 2 years, the thing you've done is you've put in $2 and you've only got $1.10 back for the business, right? Because the business died. I'm going to say it died. So all you have is $1.10 out of the $2 that you put in. Well, I know what you're thinking. You're thinking, well, that sucks. I put in $2 and I can only use 50 cents the first year and 60 cents the second year for a total of $1.10. Okay, Chris, so that should be in the third year, $2, and all they can use is $1.10 total. Is your family going to be mad because you got that business? The answer is no, because guess what they get if you die early? Chris, can you blow up that screen where it says death benefit on that illustration? No?
I can tell you what this is.
How much is the death benefit on that illustration?
This one was 4.1 million.
Okay, 4.1 million. So it doesn't matter if it's 400,000 or 40,000 or whatever the number is. The number is going to be way, way, way bigger than what you put in. So the worst thing that could happen is that if you die early, and if the insurance company thought you were going to die in the first couple of years, they would never issue you the policy. They would never sell you the policy if they thought you were going to die early. So it would have to be some kind of tragic event that happens. It was totally unexpected. So can you ever lose even from day one in a whole life policy in a mutual company that pays dividends? The answer is no. So can you see how starting a policy is like starting a brand new business from scratch, but way easier, man, way simpler. And you have you have guaranteed more money than you put in the business. Okay, so now if you die early, it's not going to be you, but I bet you have somebody that you care about in your life, maybe a spouse, a child, a grandchild, who knows, your dog, whatever, right? You're going to get way more money than you put in. So can you ever lose? And everything that I just showed you is not even using the banking concept. This is just you buying a policy and you letting the policy sit and doing nothing with it. When you start using the banking concept and all the methods that we teach, the numbers only get bigger.
Yeah. And the more of these you add, like you said, how many do you want? The more you add, the more times this just keeps repeating itself and going up and up. And if you layer them or stagger them, like we do one every year,
yeah,
it's like a self-fulfilling prophecy. And then if something should ever happen, I decide to zig and go off the 60-foot cliff instead of the 30, and I just don't go fast enough and I clip the rocks, there's a death benefit. So it's always going to self-complete.
It's always going to pay my family a death benefit. My business can never, ever lose if I am not here with the zig. Yes, I don't know
Yeah,
where
you're
that
absolutely
went.
right. It's always going to get better with time. Today's better than yesterday, and tomorrow's going to be better than today. So time is going to pass anyway. It's going to go by anyway. So, like, would you rather get on the wealth train and come on down the tracks, or do you want to wait at the train station and watch everybody go by? If you want to learn how to swim, you got to get in the pool. You're not going to learn how to swim by sitting in the grandstands and just looking at the water. You got to get in the pool. I don't know of another vehicle on this planet that has these features and benefits that allows you to do this. And if you know of one, if there's one that you know of, any listener on our call, if there's a better vehicle on the planet other than this to build wealth with these features and benefits, please tell me what it is, and maybe I'll stop all of this information and I'll start doing what you teach me. But nobody's been able to show me that in the last 15 years.
Yeah, no, absolutely. And, another thing too, that a lot of people ask us is, when they know that we have so many policies, they want to open more than one policy all at once, which typically is not the way to do it. You want to start with one policy and then start using that policy, max out that policy to the point where you're saying the same thing that 91% of our members say. And that is, boy, I wish I would have put more money into that. As soon as you hit that point where you're starting to say that, it's time for policy number 2, or as we call it, branch office number 2. Because remember, we're creating a banking system. When a bank opens one branch and that branch is thriving and they're hitting their capacity, what do? Branch office number 2, branch office number 3. It's why there's a bank on every corner of every city, state, town in this entire country, probably in the world. It's because they open multiple branch offices. We do the same thing. But don't think you need a bunch of them in the beginning, because if the bank, before they even got off the ground, opened 5 branch offices all at the same time, and they didn't even have one customer, that bank isn't going to be utilizing the resources the best way. So they start with one, that branch gets moving really quick and doing good, gets all the deposits, they're doing a lot of loans. They do the second branch office because they want to capture more deposits and then more loans and then more activity to move more money. Your bank, your private bank, works the same exact way. As you want to run more capital through your bank. And the goal is what? Can anyone tell me what the end goal is? How much of your income do you want to run through your private bank at the end of the day?
Every dollar, every dime, every penny.
Everybody should say all of it. That's right. But that, again, this is a marathon, not a sprint. That is not going to happen immediately. It's going to take time to build your banking system. It's going to take time to learn how to move your money. And I will tell you, every single one of you, you may not believe me if you're just getting started on this. All of you will have a problem later. And I know you don't want to hear this. You will have a hard time moving all of your money. As you start doing this, and as you start moving that money around that circle, and then eventually some of that money is going to stay in that segregated account, because we can't put it into the policy. We can't put more in the policy than what we took out. So the rest stays in that segregated account. Well, eventually that segregated account starts building up and up and up and up. And then we got to find places to move that money, which is exactly what we do. It's what Stephen Nagy can help you with. We have all sorts of options, from private funds to private lending opportunities to all sorts of stuff. We'll connect you with the people you need to, and you can do your due diligence and figure out what to do. That's the whole idea. But I promise you, if you all start doing this, you change your mindset and you start using this system, you will all have that problem. I have that problem. I know Brent has that problem. That's why he talks about his little green men. He has a hard time keeping those buggers moving. Every day he looks at his account, he's like, there's more of you? They're reproducing, folks, at rapid rates. And he then needs to send them out to work too, and they never complain. Man, it's just such an amazing.
Hey, Chris, I gotta just say one thing on this, because I know at least one person out there is thinking this question. They're thinking, well, yeah, but you got to put money into the policy in order to start. You are absolutely right. You have to start. You have to make a decision to get started. You have to decide to pay yourself first. Okay. Now, again, all right, guys, I want you to listen to this because it's important. Because a lot of you don't start because you think you can't afford to start. Well, I don't see how you can afford not to start personally, because you're going to have to start doing something different if you want to have different results that are going to come out of your life. So the thing I always say is you have to pay yourself first. pay yourself first. Now, again, so all you guys have heard that. It goes in one ear and out the other. Okay, pay yourself first. Yeah, all you guys have heard it, but you never do it. You see, I don't even know most of you on this call, but I know what you do with your money. You don't pay yourself first. Here's what you do. Every time you get your money in, or every time a check comes in, it doesn't matter where it's from. It could be active income, passive income, investment income. It could be a birthday card with a check from grandma. The thing you do is you take your money and you put it in somebody else's bank, right? The conventional bank of Buffalo or of Port Orange, Florida, or the state wherever you live in. And then guess what you do with your money when you put it into the bank? You pay everybody else first. You pay the house people, the car people, you pay the student loan, you pay the food, the travel, the entertainment, you pay the taxes, you put gas in your car, you pay for Bobby's soccer practice, for Susie's piano lessons, and you hope there's money left over for you. You've got to change that. You've got to pay yourself first. Pay yourself first, which is, yes, premium deposits, okay, premium into your policy, and then pay everybody else. It doesn't matter where you start. You can start at any number that you want. All right. You can start paying your premium monthly, quarterly, twice a year, annually. So let's just say you want to start with $1,000 a month. You can do $1,000 a month, $3,000 a quarter, $6,000 twice a year, $12,000 annually. Okay. All right. That's too much. Then do $100 a month. Okay. So how much are you worth paying yourself first? How much are you actually worth? I'm just going to assume everybody on this call is worth at least $2.50 an hour. Yes? I'm going to assume everybody on here is worth at least $2.50 an hour. Well, yeah, Brent, I'm worth $2.50 an hour. I'm worth way more than that. Okay, I know you are, but you're worth at least $2.50 an hour. Well, how much is $2.50 an hour worth you paying yourself first? Well, let's say you work 40 hours a week. You got $2.50 an hour. There's 40 hours in a week. That's 100 hours a week. It's $400 a month. It's $5,000 a year. So are you worth $5,000 a year? Are you worth $400 a month starting this concept, starting this process in your life? Now, a couple of you, and since I put it that way, you're thinking, well, Brent, I don't know if I'm worth $2.50 an hour. Okay, how about $1.25 then? What's $1.25 an hour? $1.25 an hour, 40 hours a week. It's $50 a week, $200 a month, $2,500 a year. Are you worth that? Are you worth $1.25 an hour? If you don't think you're worth at least $1.25 an hour, then you should probably just hang up, close down your computer, and go walk the dog on the Sunday afternoon, and you probably wasted the last 2 days of your time. You have to start paying yourself first and then pay other people. That's rule number one. It doesn't matter. And again, it doesn't matter the amount you start. It doesn't matter how you pay the premium. It doesn't matter after you get started. If you lower the premium or reduce it, you make the decision to start. All right. And a couple of you might be saying, well, Brent, I just don't have an extra $50 a week. Well, yeah, you do. Quit going to freaking Starbucks. There you go. I just freed up $50 a week for you because the people that don't have $50 a week are generally the ones you see in the Starbucks line. Okay, so like every day. And again, I'm not bashing on Starbucks drinkers. You know, I went there myself yesterday.
Yeah, I love.
I'm just saying, you can find the money. You got the money. It's somewhere, right? You have to learn to live on less, right? Yes, there are people that think they have checks left and they have money in the bank. So this is going to be hard for you because they think that, okay, so just because you got $1, you can spend $1.10. You've got to live like, and again, it's in the book by R. Nelson Nash. It's Parkinson's Law. Yeah. Parkinson's Law. In the book, Becoming Your Own Banker, go look up Parkinson's Law and see what Nelson Nash says. Page what? 28. Page 28 of the book, okay? So that's the first rule is you got to pay yourself first. Rule number 2 is pay yourself with interest, right? Because anytime you borrow money from a bank, the thing you do is you pay the bank back with interest and you don't skip a beat. You pay them back, man, every single month, right? So if you borrow from them and pay them back with interest, then why shouldn't you treat your own money that way? Because if you don't, then what you're saying is your money is not as valuable as the bank's money. And rule number 3 is recapture and recycle all of those dollars, just like I show you in the car example of my recorded presentation. So pay yourself first, pay yourself with interest, recapture and recycle the money. It doesn't matter where you start. Listen, so back in 2008, I was $984,711 in debt. That's what I owed to the third-party creditor. Do you really think I had the money to start a stupid life insurance policy? No, but I knew I had to do it because I had to do something different or I was going to continue to get what I've been getting. I had to change. Remember what Devin said earlier, Devin Burr? It's mindset, man. You got to get on that backward bicycle. This isn't what your parents, your grandparents, your friends, your colleagues, your coworkers are telling you. As a matter of fact, after this weekend, all right, when you go and tell most of them that you're about to put money into a whole life policy, they're probably going to think you're an idiot. Well, they just don't know, right? They have to be brought to the table to see how all this works, right? Again, okay, so like another thing I want you to think about is a lot of people in your life, you probably need to fire them. Even some of your family members, you probably need to fire them and get them out of your life because they don't want to see you do better than you do, right? Because what they'll do is they'll wear you down. They will drag you down. And this could be your friends. It could be your coworkers, your colleagues. It could even be your family. I know it sucks that you may have to fire a family member. I'm not saying you can't go and have Christmas dinner with them. That's all good. But when it comes time to your wealth and your money and your finances, who do you want to take advice from? Do you want to take advice from people that are actually implementing this in their life? Or do you want to get your financial advice from your broke ass brother-in-law? Those are the things you got to think about.
My brother-in-law, he just, yeah, we won't go there. Yeah. Almost let that one out. Zip, just like Hannah, right? Zip it up. Zip it. Oh my goodness. Yes, yes, yes. All right. Well, that was awesome, Brent. I got something really exciting I want to show them. And this is something that I mentioned day one, but I just barely mentioned it. And I want to really lay it out because I think everybody, even whether they're, business owners or individuals, we all like cars and we all like buying cars. So what I'd love to do is I'd love to show you guys how to buy cars through your business, but not actually buy them through your business because, some people just love leasing cars. My mom, she won't buy a car. She wants to lease a car because she wants a new one every 3 years. To her, every 3 years, she needs to get rid of the car because, oh my God, it's going to start breaking down and she can't afford the repairs. That's the mindset. This is my mother, folks. Like I can't get her over the hump. But what if she could drive a car every 3 years, turn it back in and be like, give me the new one and do that, but yet get all the money back for every one of those cars that she leases. And we all know that leasing isn't really always the most financially beneficial, but if you owned a company, it's a highly probable thing that you probably lease a car and write it off through your company.
Hey, Chris, hold on. There's something on the screen. They can't see you.
Yeah, I know. It's because I've got to do this. Boom. Sorry. Yeah, this whole thing is interesting. So there we go. There's me. But what I'm going to do is I'm not going to highlight myself. I'm actually going to go back to gallery because I'm going to share my screen for this one. But I was just kind of laying out. I know everybody wanted to look at my face when I was talking, but I was just back here trying to just explain what we're going to learn here because we're going to learn something really fun. And how I learned this, and I talked about it yesterday, is I learned this in a book that I'm reading. And it was at the very end of the book. And it literally was like 2 sentences. But I'm like, sometimes, someone yesterday I think said, boom. Got it. Mind blown. Sometimes there's just something that goes off in your mind. It sounds like this that goes, and then all of a sudden you understand it. Well, that was it for me. And I'd never thought about this. I've been doing, the infinite banking concept for quite a while. I've used it in so many different things, but I'd never thought about doing this. So, we're going to use the same format. And this is your policy. I want you to envision this is your personal policy, not your business policy. You personally are owning this. You're funding this. And you've been doing that for a few years, okay? And we know that we can take a loan. And when we take a loan, where do we want that money to end up? That's right, in the segregated account. Why? Books and records. It's the only reason, books and records. And I don't know if any of you, your personal, like literally, like, like Brent says, people think they have money because they have more checks in their checkbook, but they have no money in their account. Like, how many of you actually look at your regular checking account that you pay all your bills as like the black hole? Every penny that goes in there, somehow there's just never any money left. Any of you guys deal with that? Or am I alone? Because I'll tell you what, my personal checking account, the one that I write and pay the mortgage and the bills and, groceries and diapers and all that stuff, for some reason, that thing's like the black hole. So do I want to put my banking money through the black hole? Or do I want the banking money in somewhere where actually it's going to stay and not just disappear? Now, it's not because I'm bad at money. It's just because we don't pay attention as much to our regular personal checking accounts. Money goes into it and money goes out. And somehow there's no money left at the end of every month until the next paycheck comes. Don't tell me that's not you, because I bet you any money that's most people. But when you use the segregated account, we eliminate that. So now, remember, what we're going to do here is we're going to buy cars. All of you at this point, I sure hope, have seen the 90-minute video where we show you how to get all the money back for every single car you ever buy, drive, and own. We did it again yesterday. Brent did a presentation. I showed you, how I did that YouTube video on my YouTube channel of how I paid for the last 3 cars and got all the money back, and then some, and then some. Remember that? Like the last Porsche, by the time I'm done paying for her truck, I will have gotten, I think it was $3.63 for every dollar I spent back on that vehicle. So that's pretty cool. But, we still, when we do that, we still don't get a tax write-off. So let's do this. Let's buy a car. You've got that policy. And what we're going to do is we're going to take the money from the loan and we're going to purchase a car. Now, what kind of car? See that? If any of you know cars, you'll know that silhouette is one of 2 different vehicles. That is either a BMW M4, which is a hot car, or maybe a BMW M3. We could argue that it's one of those 2s. Yeah, that's right, Jet. It's a BMW M4. That's what we're going to call it. And I urge each of you, just, take a Sunday, not today, but take a Sunday and go to the BMW dealership and just drive an M4. You'll understand why we chose that. It's a fun car. I don't own one yet, but someday. All right, so we got that car. We purchased it with money from our policy. So, but that doesn't solve it. And then we have a company. Okay, and we've always heard of those really fun companies where they, the owners and the CEOs and the key employees drive company cars. So what we're going to do is we're actually going to lease this BMW M4 that we own personally. We own it. Our banking policy owns this and paid for it. What we're going to do is we're going to lease that M4 to our company. And we're going to have, this is very important. So it's why it's right at the top. We have to have an attorney draft the lease because this lease has to be correct. And what's interesting is the way we're going to be able to help you with this is our mapping team. Okay, Andrew has already been trained on how to do this, and he found a really cool software that allows him to basically amortize a lease agreement payment. And literally, he can dial in your lease payment. You want that M4? Great. How much does your company want to pay for it? And how much money do you want to make on this? He can literally design your lease numbers to be whatever you want. And let's just say on this particular car, this M4, let's just put a number to it, right? Let's just say in 3 years from now, can anyone tell me how much in 3 years, how much would a BMW M4 be worth 3 years from now if it was a used car with, I don't know, let's say 40,000 miles? Can anyone just give me a guess? I'm just trying to get you guys to play along. Okay, it's got 40,000 miles on it because you drove a lot. It's a company car. Why wouldn't you just drive it everywhere, right? How much do you think it's worth? Someone give me an amount. Come on. 65 grand, 35 grand. All right, let's use 35. 65 is pretty aggressive for an M4. You might be able to get it, but that's pretty good. So let's just say your residual value, I don't know. If you think you can get 35, let's put a residual value on it, kind of like how the leasing company does, because they screw you. They just put 25 grand. So they're saying in 3 years from now, even though you know the car is worth 35 or you think it's going to be worth, the residual value is only 25. So now we got a $25,000 residual value. And if we did that, we lease that car to our company. Now let's just assume that our company then is going to pay us back. So we'll go one step further here. Our company is going to make monthly payments, and we're just going to set up a bill pay. our business.
Can you hear me?
Yep.
Hey, will you just write in a different color besides red, maybe like a white or something?
Yeah, I wanted to get all the things on there before I put the numbers up. So I just wanted to make sure I got all the slides out. So I'll start writing on it, and I'll use, what color would be good on that? Maybe yellow? Can you see that?
Yes, no, that looks good.
Okay. All right, so let's go back to our numbers. We got a BMW M4 that we bought. Okay, M4. We bought that car, and we've got we think it's going to be worth $35,000 in 3 years from now, but we're going to put a residual value of $25,000. Now, why is all this important? Because your lease agreement that your attorney drafts is going to ask that. So the first thing when Andrew's going to do this mapping for you is he's going to say the residual value's $250. Okay, and he's going to put a monthly lease payment, and we're going to do a 3 year. Oh, I'm sorry, you only wanted a 2 year? You're the bank. You can do any lease you want. You want a new car every 2 years? It's just going to be hard to get all the money back in 2 years. We did this with a vehicle on 3 years, and it worked like a champ. So we did 3 years, 25,000 residual value. Okay, we got to put that. And let's just say this car costs 60 grand. Okay, so that's a $60,000 car that we paid. So we got that. Now what's going to happen here is we're going to come up with a lease payment. So does anyone want to guess at what a lease payment would be on a $60,000 M4? Andrew, what was that $60,000 number? Do you remember?
60,000 with a lease residual value of, let's say, 35,000.
Now do 25 on the residual.
25.
See, he's doing it right now. Yeah.
6% for 2 years.
Now do 3 years. Sorry.
Yeah, let's do 3 years. Is 1,189.77.
1,189.
1,190.
Okay. Sorry. Let me get rid of that real quick. 1,000. I'm going to ask you one more time. I started writing it wrong.
Sorry. 1,190.
$1,190 a month. Okay. So now that's an expensive car payment, but if you owned a business and you wanted a company car, would that be too much to pay for a $60,000 car? That's for you guys to decide. But what we're going to do is we're going to go with it. You really want that company car. So we're going to do $1,190. That's truly the number. Okay. And we're going to put that money back in this segregated account. All that money is going to go back in here every single month from your company. Now, can I ask a question? This $1,190 is that a tax write-off? Can we write that off? Like, can we write this thing off on our taxes? Anyone that knows leases knows that you can write 100% of that tax or that car payment off because your company is paying for that car for business use. Now you got to prove, there's some things you got to prove that you can do that. So that's the lease arrangement. And again, folks, we can dial this to be whatever you want. We just did it really quick. Now, Andrew, can you do some quick math?
Yep.
$1,190 a month. Okay. Times 12 times 3 years. How much money after 3 years is sitting in our segregated bank account? $42,800. Okay. $42,800 is sitting in that account. Now, what you'd be able to do here is now you could take that money, that 42.8, you could then repay your loan. Okay. So 3 years is up. You got this car sitting in the driveway. Does anyone think you're going to have a hard time so you got 42,000 of a $60,000 car. So Andrew, 60 minus 42.8, what's the amount we got to sell this car for?
60 minus 42,800 is 17,200.
$17,200. Do you think anyone's going to have a hard time selling a BMW M4 for anything more than $17,200? Because we already talked and we thought the car was going to be 35. But if we followed this formula and you sell the car for anything over $17,200, that is what we call profit. So you just made money, number one, on the lease payments. Okay. You made money right there. You made money on the policy the whole time. Then when it's all done, you just take this segregated account and you just pay your policy back, the $60,000 plus the interest, whatever that worked out to be. Let's just say that's another 3. So that's 63,000 hypothetically that you pay your policy back. And anything that you sell the car over 17.2 is pure profit minus what we got to pay back. Do you guys think you put a little extra money in your pocket? I think you did. And then you got to drive this really cool car. Okay. There was a company car. You got a new one every 3 years. And all it was is a tax write-off for your company. I swear, when I saw this, I'm like, now that is pretty sweet, because if for, this is the business day. So I'm assuming most of you have some type of a company. Now, are we all going to do a BMW M4? No. I mean, maybe you do a Kia, maybe you do a Honda, maybe you do one of those new Chevy SUVs. They're pretty awesome vehicles. I mean, all the new cars are amazing. Doesn't matter what the car is. I just picked a BMW just because it's a sexy car. And in this case, you not only get all the money back for every one of the cars you do this with, this gets better over time. Like Brent showed, with that business example, you think that's going to work here. It's going to get better and better as you keep buying more and more cars. You get more and more money back. But your company benefits from the tax write-off. And also, if you ever lease a car through your company and your company gets hard times like COVID hits and you can't make your payments, you're stretched. Remember that example I gave you of talking to yourself in the mirror? Let's just say there's a couple months you can't make this 1,090. Do you think you, the banker, is going to allow you, the company owner, to maybe take a couple months off and put it on the back end of the lease? I think so. Do you think if you did that with your lease company, do you think they'd be super cool with that? Or do you think they'd make you fill a bunch of paperwork out, pledge your second child and maybe your third child? I think that's what they would do. But because you're the bank and you can make the rules and you control the money, none of that exists. So I was really excited to show this to you folks, because when I read this, I just got super stinking fired up. Did everybody find value in that? Was that helpful for you guys? Now, let me give you one additional thing. Can we go one bonus round? Let's say you're doing really well. What is the most important thing we can do in the short time that we have here on earth? We talked about it day one. We can give, right? We can give. So now let's just say you're on your second lease. So you did your first one. Okay, but now you're on car number 2 and you already know it doesn't even matter if you sell this car, you got all the money back on the lease. So now in 3 years, this car is just bought and paid for. What if we did something like donate this car to a family in need? Okay. What if we did that? What if we just donate the car? Does it matter? Does this car owe us anything? Do we have to sell this car? Is there anything this car owes us? It owes us nothing, because the policy and the process did all the work for you. And you drove a company car and you got a tax write-off. So at the end of 3 years, this car's bought, paid for, and it owes you nothing. None of the money that came in from the lease is required to basically make up any difference. So that money just goes right back, pays the policy. This is just all profit. Wouldn't that make sense? If you were a good person and you really wanted to subscribe to, if you give, it's the most powerful thing you can do, and you just give it to a charity, wouldn't that make you feel good to find a family in need that can't go get groceries? They can't go to the doctor's office because they don't have a car. They have to take a bus or they have to take an Uber every single time. They can't take an Uber because they don't have the money to do that. How good would that make you feel? Folks, I just wanted to go that little bonus round, because sometimes in this world and in this journey that you're going to be venturing into or already are, there's going to come a point in time where you're probably going to have more money than you need. And at that point in time, this is going to give you that ability to do the most powerful thing on earth, and that is give. So I just wanted to put that in there. So now we're going to move on to the next section here. Oops, I missed one. And I'm going to hit this really quick. This is Sodi. Many of you know him from the 1010 trading. And I don't know who that guy is. It's an ugly guy with his arms crossed. But anyway, what I'm going to do is I'm just going to do a real quick slide. And I want you to follow quick because it's the same thing. But some of you on here trade stocks. Maybe some of you trade options. Some of you are probably part of the 1010 trading strategies with Sodi doing that. I just want to show you another business way, another way you can use your banking policy and make money twice for doing the same thing you're probably doing today, which maybe you're trading. Maybe you've got a brokerage account with Schwab or TD Ameritrade and you just want to put some more money in there. Well, I want to show you what I did. And this is actually my numbers, my policy. Here's what I did. I had a policy, and I don't remember how old the policy is. It's an older one than I had, and it had $18,000 in it. And what I did is I took that 18K out as a loan, went here in my segregated account, which is that little blue taped up checkbook you saw. And what I did is I did a transfer into my TD Ameritrade account. Now I did this back in March. Why would I have done this in March? I want everybody to think about what happened in March, okay? Wasn't March the big crash? Like, isn't that when the stock market did one of these? Woo, because of COVID? Do you guys remember that? When the market just literally fell apart and just went down and hit that level? You guys remember that? When that went down, stocks dropped on average about 30%. So if you know that stocks went down 30%, does that not, like, some of you are like, oh my God, that's an awful thing. And some of you are like, man, that'd be a great time to buy. Wouldn't it be a great time to buy? It would. So here's what I did. I took my policy and I had this 18 grand just sitting in that policy. I took it as a loan and I put it into my brokerage account, 18K. Sorry, I'll get back to my yellow. And all I did is I said, you know what? I'm going to make my brokerage account, okay, my TD Ameritrade account, pay my policy back at a rate of 7% interest. And all I did is I just did a real quick, promissory note so that I didn't forget. And then let me just show you kind of how this worked out. I didn't really do anything fancy here. All I did is I just took money, I loaned it and put it in my brokerage account. That's the only thing that happened here. Well, back in March, I'm going to show you the trades I made. And oh yeah, here's my policy. I'd be remiss not to show you guys the actual numbers. So here they are. It was 14 years I've had this policy, not a big one, 10 grand putting in. So I'm right here, okay? So how much cash did I have? Well, some of you would say I had 114, but if you think I had 114,000 sitting in cash value, well, number one, you would probably not be taking advice because that means I'm not moving my money, but I had 18,000 in there. So out of that 114 that in cash value that's making interest, I only had 18,000 of it not working. So I had to get that money working. So that's what I did. Okay. So we got that. Now moving on, here's the trades that I did. And I'm just going to show you the actual trades down here. This is actually a cut out of my TD Ameritrade account. This is actually Thinkorswim showing the trades. So I was nervous. I didn't know if the market was going to keep going down, but there's this company that many of you might, or I don't know, maybe you guys don't know of this company. They're kind of a new company. Anyone ever hear of a company called Tesla? I mean, they make cars. If you haven't heard about them, it's okay. You will soon. This guy, Elon Musk. But Tesla's a pretty good company, and I kind of like what they do. Yeah, exactly. So I knew some people wouldn't know what Teslas were. It's okay, guys. They're getting more popular pretty soon. They're like this electric car. They got like this thing that they launch rockets into space and land them on things. I know it's science fiction shit, but it'll be here soon. So what I did is right here on March 23rd, I took some of that money, okay? Not enough. I bought 6 shares of Tesla at $24.90, okay? 6 shares at $24.90, and I paid $415. Now, when it comes to trading stocks, I don't like long holds. I get super nervous holding anything long-term right now because I know what's coming in 2022, 2023. And at that time, even though if I could reverse, I knew that this was going to stop and then come back up. At that time, I didn't know. I thought this thing could just keep going straight down to wherever it was going to go. So I only bought 6 shares. And then when, right here, we got into May, on May 12th, I looked and I remember I was doing a 10-10 trading. Some of you might've been on it. And I saw that my stock had gone up to 832. That's more than double. I'm like, I'm out. I sold the stock and there you go. Okay. Here's my sell order right there down at the bottom. I made 107%. Oh, wait. I'm sorry. I made 107% on that. But then how much did I tell myself I was going to charge myself? I think it was 7%. So I charged myself 7% and I had to give 5% back to the insurance company. Did I still do okay with this trade? That was a good one. But you know what? As soon as that trade was over, I got really mad at myself because what did Tesla keep doing? Going up and up and up. And I'm like, oh my God, I missed out. And I watched this thing for a long period of time. And then all of a sudden it got to September and I'm like, all right. In September, if I'm not mistaken, I think this is when they did I think it was a 5-for-1 split. But I went back into that company that many of you, someday will know about called Tesla. And what I did, and that's probably not the right color there. Let's do blue. Okay. I went back in and I now bought 30 shares. Oh, big roller, right? Put it all on black. So $338 after the split, I took a $10,000 position. But then the next day, I'm like, oh man, I should have bought more because I saw, look what it did. It went from 338 to 348. So I'm like, all right, I'm going to make this around 50 shares. So I spent another 16. I used almost all 18,000 of my money. Then I got nervous again on 9/21. That thing was up at 423. And I'm like, well, that hits my rules of engagement. I'm out. And I sold for 21. Now I only made a 23% return there. Oh, 23% minus the 7 I got to give back, minus the 5. Listen, that's a good day in the office for any stock trader out there. But the story doesn't end there. And I'm going to do one more and then that's it. And here's my trades down here. You can see, just so you don't think I'm making numbers up. And then here I did it one more time. 924, 14 shares. It filled twice. And I wanted to make sure everybody understood it. It didn't fill all 20 shares. So I bought 20 shares, but it filled at 2 prices because the market maker made a penny on me. And I got in at 7,604. And this is Tesla again. You can see I'm just doing the same thing. And then a couple of days later on 928, I'm like, woohoo, score. Not $424 a share. I cashed out at $84.99. I made 11%. Yes, I know some of you that are, the guru stock traders are like, dude, you should have just held that stock and you would have made way more money than you just did. You're absolutely correct. But I follow a set of rules when I trade. And that set of rules said you sell when you hit your target. And that's what I did, folks. I followed the rules. I probably could have made a lot more. Had you guys just bought it, closed your eyes and let it ride, you would have made more money than I did. But I just wanted to show that example just so that you all could see another way that you can use your policy. All right. I think that brings us right into the next section there, Brent. Putting policies on your key business people. Brent, I'm going to kick this one off and then Stephen, we're going to go right after this one into our favorite section, which is going to be the IRA. So real quick.
Yeah, I think he did the key business just now, right?
He did, but I just, because he already did this, I want to tell a story. So I'm just going to tell a story because I want everybody to get, I want everybody to see this real quick. Sorry. Spotlights. There we go. So I want everybody to look at the badge that I have on my chest. And I want you to all think like, who do I look like? Who do I look like? If you walk into some institution, who has one of these badges? And they're usually really proud. Normally they have a tie and a suit jacket on. Who would that be?
A conventional banker, man. They got the VP.
Heck yeah, man. We all got those badges, right?
You got the VP of the loan officer. You got the VP of the safe deposit box, the VP of the tellers. You've even got a vice president of the door opener. Everybody's a VP because you got to make them key people.
Yeah. So why is it that, banks give these things out like they're candy, like these VPs, like there's so many of these and you walk in and everybody's a VP. You're like, wow, man, a lot of executives in here. And you got to start asking yourself, nobody's ever probably thought about it as to why would there be so many vice presidents at a bank? And Brent said it, because the bank needs to create a bunch of executives so that the bank has a insurable interest in those vice presidents. So why would the bank want an insurable interest? Where does that come into play? Well, we've been doing this all day. The bank wants to take whole life policies out on as many people as they can because banks are the #1 purchasers of whole life in this country and probably in the world. They buy more whole life than they do all the land and buildings combined. If you don't believe us, go on to Bank of America's balance sheet and look for yourself. You'll see it. Look at Wells Fargo. Look at them all. You'll see exactly what we already know. They own a ton of whole life. And, Brent always says, is that because they're stupid or do they know something we don't know? Well, they know exactly what we've been learning all day. So now you got this VP and the bank wants to buy lots of whole life. They can't just buy whole life. They needed a body to insure. And now that they gave that VP the tag makes them an executive, which gives the insurability to the company, to the bank, and the bank just buys policies on them. And the bank does exactly like Brent showed, uses those policies over the course of the time that employee is there. But when a VP gets this badge, right, that VP badge of honor, they get a pay raise. They usually get a deferred compensation plan, which is nothing more than the whole life funding a part of the retirement, like Brent talked about. And they also get a death benefit fully paid up for their family, $50,000 or $100,000. That employee sticks with that bank all 30 years, maybe 23, whatever it is, retires, gets the deferred comp, graduates. Nice way of saying dies. So that VP dies. Who gets the death benefit? Well, we know that the VP's family gets $100,000 paid up death benefit, but who gets that other $2, $3, $4 million that's accumulated in that policy? The bank does. Does that $2, $3, $4 million pay for every premium deposit they ever made into that policy? You're darn right. And did the bank get to use all that money the entire time they were doing that? Darn right. So what we've got is a neat little thing that we're doing. We just started doing this. So anybody that starts a policy with us, anybody that basically starts working with the money multiplier, we are going to give you your own VP of Cashflow. It's got the little BYOB logo on it. It says VP of Cashflow because we want you to be the vice president of your bank, because we want you to understand that you are now in charge of your cash flow. So just a neat little thing. So I'll end it on that one.
Hey, Chris, I think that is really cool. And that's the first time I saw that VP of cash flow. So I'm sure if you got that VP, Vice President of Cash Flow, I am sure you ordered one that says President of Cash Flow, and that's probably in the mail already, just being delivered to me. Is that right?
That's right. Shauna already took care of that. Yep. And she's got that one in the mail for you. So you will be getting your President of Cash Flow very soon. Shauna, can you get that ordered and get that shipped out to Brent? Oh, I love it. I love it. Oh my goodness. We have too much fun with this. All right. So now let's get into the fun stuff. Let's get into IRAs. So Stephen, I'm gonna bring you to the forefront because you are, let's see, how do I do that? Oh, I just asked to start a video. No, I'm just trying to make a couple people on the panel here. So we're gonna spotlight Brent, and there he is, and I got to spotlight Stephen. There we go. All right, now we got everybody up. So,
hey, real fast before we get going, I was just going through some files while we were talking today, and I found my old dream book. We were talking about this yesterday, right, or Friday. So, as financial advisors, we used to, a big part of what we did was talk about goals and dreams and, how you're going to create your financial plan to be able to accomplish that. And, that's what led me into real estate investing and ultimately, meeting people like Chris and Brent. There's so much better ways out there than the traditional 9-to-5 invest in a 401k, you meet with a financial advisor, diversify through mutual funds, et cetera, fill out these dream books. It's garbage because they don't work. And that's why nobody retires at the age and the lifestyle that they want to. So that's why we're here. So anyways, I just found that was funny.
Oh my God. You probably spent an hour looking for that book. You found it. All right. So what we want to spend the last part of this on is we want to spend it on IRAs, 401ks, solo Ks. And we really, we're not saying that privatized banking, the infinite banking concept is better than your IRA, your 401k, or your employer sponsored plan. We're just saying that it's different. And actually we probably would say that it's better too, but trying to be fair here, we're going to say it's just different. And it's different because the banking policies are what they call non-qualified assets. The 401ks, IRAs, solo Ks are what they call qualified assets under IRS rulings. And there's a lot of things. Stephen, can you just explain what some of the rules are with a qualified retirement plan like an IRA or Roth, a solo K, a 401k?
Yeah, absolutely. So traditional IRAs or traditional 401ks. So the traditional word simply means how they're treated from a tax standpoint. All right. So there's two different types of retirement accounts. There's a traditional and there's a Roth. Okay. So a traditional is going to be money that goes in before tax. All right. So the thought is you can, put the money into this IRA. It goes in before you pay taxes on it. So it can reduce your tax liability for the year. So there's certain strategies where maybe, you can put some money into one of these and it'll lower your income enough where you go into a lower tax bracket. And then what happens inside of there, once the money's inside that traditional IRA or traditional 401k or any other type of retirement plan, right? There's a bunch out there, SEPs, Simples, HSAs, et cetera, four plans and 5 plans and all this stuff. But it's traditional. So what happens? It goes in before taxes, the money grows tax deferred. And then once you get to retirement age of 59 and a half years old, you can start pulling the money out. Okay. However, there's a couple things with that. When you pull that money out, first off, that's when you're going to pay taxes on it. Okay. So all the initial contributions, as well as all of the growth within that policy is all going to be taxed when it's coming out. Now, the kind of the rationalization for why that happens is they say, okay, during your earning years, like right now, you're going to be in a higher tax bracket during your earning years because you have more money coming in. You have, you're going to be at the highest salary in your job. So you're going to be paying the most taxes. So it allows you to lower them. And then what the thought process is supposed to be is once you retire, you don't have all that earned income and salary any longer. So now you'll be in a lower tax bracket. So when you pay the taxes on the money coming out in retirement, you'll be in a lower tax bracket. So you'll be paying less in taxes. That's kind of like the traditional thinking of how that works, right? However, there's a couple challenges with that. So number one, the money that goes in, you're limited to the amount of money you can put into these accounts. So with an IRA, you're limited to like $5,500 or $6,500 a year going into an IRA. So you can't like put, tens of thousands of dollars into it. And even with a 401k or a solo K, you're limited to $55,000 to $65,000 contributions into these. So you are limited how much you can put in. Once the money's in there, in 5 years from now, if you're like, well, I'd like to pull some of that money out and use it. Well, they're going to not only charge you taxes on all the money you pull out, but they're also going to charge you a 10% penalty on any contribution or profit that you pull out of that IRA or 401k before you're 59 and a half years old. All right. So you're putting all this money in there, hoping it's going to grow in, mutual funds and index funds and all this. And and hopefully you're going to, get some growth on it between now and when you're 59, 60, 65 years old and you start pulling it out. All right. Now, first off, there's a lot of fluctuations that occur and on top of all the fees that are going to be charged during that time when you're investing with the financial planner and these mutual funds and different things. So there's just a lot of stuff that can happen between now and then where, it might not be the best strategy, right? So a Roth IRA, same rules as far as contribution limits, same rules as far as pulling the money out. Now, some of the contributions, as long as it's been there for 5 years, you can pull some of it out, but it just gets kind of weird as far as working with that and the tax and you're an accountant and stuff like that. It almost isn't worth it, right? So, but with a Roth, the idea is the money's going to go in after tax, okay? The money within the Roth is going to grow tax-free. And then when you start pulling it out, you'll never pay taxes on any of that growth. You already paid the taxes. So if you're going to have a retirement account, you probably want to have a Roth, right? Because it's going to allow you to grow that money tax-free. And if you're going to have an IRA or a solo K that's a Roth, you're probably going to want it to be a self-directed account, because that means you're going to at least control the investments. Because with a typical Roth IRA or Roth 401k, you're still dealing with the stock market. If you're at Fidelity or Morgan Stanley, then you're only able to buy the mutual funds and the different funds that they offer. Okay. So you don't have control of your money. You're only able to purchase what they're allowing you to purchase. All right. So it's good for the tax-free growth. However, you still have the contribution limits. You still have, you can't pull it out till your retirement age. And then you're still limited unless you're in a self-directed on what you can actually do with it. All right. And then once you do invest it, it's growing. So those are basic, when it comes to IRAs and 401ks. So where do you want to?
Where I think we should go is there's somebody yesterday that was asking me about, a solo K, which is it's basically a single member 401k done through your business. And they were saying, basically a comparison between a solo K and the privatized bank. Now, I've got a presentation here that we'll do after we talk about the solo K, but solo Ks, in my opinion, if you're a self-employed business owner, if you are the only employee, or maybe you and your spouse are the only two people or significant other, whatever you want to do in the company, I think a solo K single-handedly can be one of the best retirement plans they can use. Can you just explain a solo K to them and why for a small business like that could be a really good vehicle to use because of the loan provisions and everything?
Yeah, I mean, so if you're gonna go with qualified funds and you want to take advantage of these qualified funds as opposed to just running everything through the IBC, which I'm sure Brent is ready to hop on here and say, no, but that's a whole nother story, right? So if you're gonna have the company and do those strategies, a solo K is definitely the way to go because it's going to give you the max. So solo K is treated by the IRS the exact same way a 401k is as far as contributions. So it gives you the higher contributions. Again, an IRA, you're limited to $5,500 or $6,500 a year contributions. A solo K or 401k, you can put up to $55,000, $65,000 annually into a solo K. All right. So you're going to be able to get a lot more into it. A solo K, a self-directed solo K is also going to give you the most flexibility as far as what you can invest in. So the way they're treated by the IRS, you can use it for flipping, you can use it for rental properties, you can use it to do private lending, you can use it for all these different uses. So a Roth solo K is the absolute best because you're going to have that tax-free growth over the time. And then if you do run into a situation, because there are, and I didn't even mention this, but with qualified funds, there's also a lot of regulations and rules over how you can use the money. Okay. So what I mean by that is I can't go out and buy my own vehicle, or I can't go out there and buy my own home that I live in with a solo K. I can't use solo K retirement IRA money, even if it's self-directed. I can't use it to market my business or to advertise my business. There's just, you're not allowed to. If you do that, it's considered what's called self-dealing, and it can make the entire account a tax liability. So you actually lose your entire qualified retirement account. So you got to be very careful in how you use these. But if you're going to, the solo K definitely gives you a lot more flexibility. And the reason why the solo K is nice, and keep in mind, a solo K is for you, if you're an individual LLC, if you own it by yourself, or if it's like you and your wife or husband, your spouse, then you can still qualify for a solo K. Now, you can't have a solo K, however, if you start adding employees. Then you'd have to create a 401k, which then comes with a whole nother set of rules and regulations as far as that goes. You can't discriminate, stuff like that. So we do have solutions for that through the IBC strategy, which Brent hit on briefly a little bit earlier, and we could talk a little bit more about. But with the retirement, with the qualified funds, there's just a lot of things you got to be very careful with. But one of the reasons why it's at least better than an IRA, a solo K, is because you do have the loan provision in there that allows you. So you could take a loan from a solo K, just like you can with your 401k at work. You can take a loan of 50% or up to $50,000. And then with a loan from a 401k or solo K, you can use that money for anything you want. So if you need it for startup costs for marketing a business, or to go out and buy a vehicle for yourself, or down payment on your own home you're going to live in, at least you can use the solo K for that reason.
On that, like, let's say somebody set up a Roth solo K and they got it up to 50 grand, and they wanted to take a loan for 50 grand from their solo K and then deposit the money in their banking policy, use their banking policy to buy that BMW M4 and then lease it back to their company. That would work, right?
Absolutely. And the nice thing with the solo K is you are going to pay interest on that loan from the solo K. However, with a solo K, one of the cool things is the interest that you pay goes back to yourself. All right. So you're going to pay typically 2 points above what prime rate is. So you could probably pay 3 to 5% right now. You kind of set the terms and you create a plan. Now you do have to make the plan loan repayment on a monthly basis. So you do actually have to set that up and structure where you are paying back the loan with interest on a regular basis. But if Chris is going to draw this up, it'd be really cool, because what I see happens is the whole point of a retirement account is to have the money in there uninterrupted growing for you until your retirement age. So if you start pulling loans out, even though you're paying yourself back the interest, you're still losing out on the growth within the retirement account because you're using that money for other things. But if you take that money and you use it to put it into a IBC policy, then you're growing your money at the same time. Even though it's out of the retirement account, at least it's still growing for you. And then all the interest you put back into it is still beneficial for you. So that actually, Chris, would be a really, really great use of a 401k or solo K loan, would be to pull that out, because the interest goes back to you anyways, put it into the IBC, and then get it back into the policy by doing a loan from your company.
Yeah, I mean, let's quickly look at that example and just kind of use a solo K to do this whole thing, right? So the only thing we would have to change on this to make that work is, let's say somebody has a solo K, or heck, even if they had a 401k, as long as they didn't think they were going to leave their employer, maybe they got a 401k. So they could take a loan. I'm just using 50 grand, could be any dollar amount, put it into the policy. Once they get it issued, take that money out. Let's just say they took 35,000 of that out and they buy a car. Now you might only be able to get an M2 or an M1. So we'll just put this as an M2. Okay. Sorry. No M4s this time around. 35K you pay, and then you do the lease to your company in the same way. And now maybe the payments, let's just say $800 a month. And you then take that money, put it back, that money in here, and then you can use that to pay off your 401k. And then when you sell the car, you pay off your policy. That would work super well. What are your thoughts, Stephen?
I love it, man. I love it. It's just, I mean,
I know, just keep like layering it in one after the other. All right. So the other thing I wanted to show real quick, and now I got to kind of get my slides back. I'm a little off. So Stephen, with a 401k or a solo K or any of those, there's some negatives to it, correct?
yes, like everything.
Like taxes, right? Unless it's a Roth, there's some taxes involved in that. So real quick, I'm going to share my screen again. And what I'd like to do is a little exercise. I don't care whether you guys want to use an IRA, a self-directed IRA, a solo K, your 401k. Doesn't really matter what instrument you want to use. We're going to compare a tax qualified employer sponsored retirement plan against this right here. You remember yesterday I was showing you that policy that I started, the 30,000 a year going down to 12, and I showed you the retirement and how I was doing it. Well, Andrew was nice enough to actually put together the actual illustration of all the numbers, since everybody likes nerding out on the numbers. What we're going to do is we're going to look at this plan. Now, this plan, I put 30,000 in for 10 years and then 12,000 in every year thereafter. Sorry about the chicken scratch, folks. It doesn't get much better than that with a mouse. Okay. Now I want you to pretend over on this side, you got your 401k, or I can't remember who it was, but let's just call it a solo 401k. Same dollar amount, 722, because this is how much my policy has. Your 401k had the same amount, 722. I'm going to take $93,000 out every single year, all the way up till I'm age 100. And when I'm age 100, I still have 100. And it's kind of funny. Like, do you guys see what's happening here? Like, look, it's building again. Like, I can't kill this thing. It's like a cockroach. Like, it just keeps on going up. You know, look at this. At the 100th year, I still got 114,000. I just couldn't get the darn thing to spend all the money. And I took 93,000 out every year from age 66 to age 100, tax-free. Now, in a 401k, we could do the exact same thing. The numbers would be identical, but there'd be one change. Stephen, what would be the one difference between this example and if we were going to use a solo K for this example?
I mean, well, when you pull the money out of the solo K, it's gone. So it's not going to be growing for you.
Yeah, so you probably wouldn't have this growth, but let's just assume that, you know, your stocks just did really well and it compared just like this. What's the one thing that you'd have to do on a regular, not a Roth, but a regular solo K or a regular 401k?
Sure, you're paying taxes on all
taxes. Okay. So what I'd like everybody to do, okay, and I want everybody to participate in this. I want you to grab your calculator, and all I want you to do is I want you to pick any year, okay, any year you want, but just take 93,000 bucks. And I want you to figure out, what do you think your tax rate is? If now was the time when you're 66 years old, how much do you think your tax rate would be? Would it be 15%? Would it be 20? Would it be 25? Would it be 30? How much money would you have to give the government on each one of these $93,000 annual deposits? How much? So if you got 93, I want you to pick your number, folks. So is it 15? So if we did 15%.
More than that.
Well, I know, but we're just going to kind of go there. 15% on 93 would be $13,950 in taxes. So you'd give up $13,950 in taxes. So now your livable income dropped to 79,000. But I doubt anyone on this is a 15% tax rate. Maybe someone, but let's say you think 28 might be a better number, state and federal. You think that's kind of a better number to use? So what would 93,000 times 0.28? That's 26,000 bucks. Okay. $26,000.40 or 26,040 minus 93,000. That means now you're living on 66,000 bucks. So now we're going to live on 66,960. Would you rather have 93,000 or 66? But I know someone on here's got to be in a 40% tax bracket. We got to have at least a few that are in that tax bracket. And now 93,000 times 0.4, that's 37,000 minus 93,000. That means you're now living on $55,800. When I went around and I interviewed multimillionaires and billionaires, And I was surprised at the fact that not many of them were putting much money or not intentionally trying to put more money into 401ks. Do you understand why? Do you understand what they understood? They understood that they wanted to keep as much of the money as they can. So if we're comparing the two of them and we just use all things considered equal, no market performance, like nothing like that, just the same numbers for the same numbers, but we put taxes on one side and not the other, you can see where this becomes incredibly valuable. Now, let's go bonus round. You know, your 401k, there was probably fees in there. Okay. But the other thing too, what else would have happened with your 401k? If you died in your 401k, if you die, how much money would be left to your beneficiaries? Well, we did the math for you. It's right here. If I die with the private bank, I don't have the death benefit, but it's significantly more. It was like hundreds of thousands, 700. How much money does my family get? The answer is more. We don't even need to know the number. We don't need to nerd out in numbers. If you died here with your IRA or your 401k or your solo K, they get the balance, which is shown right here. This is your balance. That's how much they get. Okay. And if you did a really good job and you made it to 97, your family gets 21,000. That barely will probably pay for your funeral when that time comes that far in the future. But over here, I bet you any money, I got at least a $300,000 death benefit. And it's probably even more tax-free. Is that going to pay for my funeral? Is that going to pay for some extra money for my family to live? Yes. You can see the difference is never comparable. You can't compare one for the other. It's very difficult because they're two different animals. That's why there's no silver bullet, folks. There's no one vehicle out there that will solve all your problems. You're going to need multiple vehicles, multiple strategies, and most importantly, multiple income streams. And if you start using this banking policy to provide those multiple income streams, I'll tell you what, retirement isn't going to be something you're worried about because all the different income streams from all the banking activities you've done, from all the banking policies you have, will coast you right through, and you'll have multiple channels of income coming in every single month. And that is the name of the game. Oh, I'm sorry. Andrew just clarified my death benefit at age 88. What was it? $2,666,000. $2 million and something dollars goes to my family at age 88. So in this one here, if you had a solo K, your family gets 142. You think your family would want 2 million or $142,000? Exactly. All right. So where are we at? Look at that. We are right on time. That's incredible. Brent, there was something else to, IULs.
No, hey, Chris.
Yeah.
Anyway, awesome. I know you're about to close it out pretty soon, but the thing I wanted just to remind everybody is about the Wealth Wednesday webinars that you do every Wednesday. And if you guys aren't participating in those, I highly suggest that you do. And then you also do the Ask Me Anything on Wednesday afternoon too.
Yep.
And then I always tell everybody just to go out online, social media, and just follow Chris Naugle. Just whatever Chris Naugle is doing. I mean, there's tons of stuff he's putting out there on videos and YouTube and podcast, all of that. So follow Chris Naugle, watch what he's doing. He's always talking about this stuff. And then I believe, Chris, that you and I'm not sure who else on the team is also going to participate. I know Andrew will. The thing is what we're going to do videos. We got about 80 videos all lined up, and all we have to do is record them. And I think we're doing that sometime in the next couple months. So those will be coming out, and so those will go to all of the members as well. Those videos that we're doing, those advanced strategy videos, how to use the policies. And I think Andrew's already outlined up about 80 of them for us to do. So
and those are going to be given for free to all of our members.
That's right. So I just wanted to remind everybody of that. I know it's about 2:30. I'm going to have to jump off because I got another appointment. I mean, if you guys want to go on and answer questions or do more chat and stuff, I'm just going to have to get off myself. But I think it's been good. I think we could have used a couple more hours because there's a couple things on my list I would have liked to go on over, but that's okay. Hey, but that's all right. What we'll do is just start adding them to the Wealth Wednesday webinars that we do, the other information. So all of this stuff continues to build up on each other, right? And yes, there's going to be some stuff you've already heard for the first time, maybe, or Okay. And then you hear it again. But so the more you hear it, the more repetitive it is. Right. And it's just, okay. It's the same thing. Like every time I read the book by Nelson Nash, Becoming Your Own Banker, I always learn something new. And I've read that book, I don't know how many times, at least 50 times I've read that book from cover to cover. But each time I read it, I always learn something new. I make a point to read it at least one time every year at the minimum, because anytime we do just like a mastermind event, which we usually do on an annual basis, I always read the book before the mastermind event, so I get my mind all fresh about all the stuff that I'm going to talk about. And it seems like there's always times in there, if I'm reading the book, there's like, oh my gosh, I haven't been talking about that the last several months, because I forget and stuff. So again, I always say, just the more you get around this stuff, the better it gets. So I think it was a great, just a deal that you put together. And I appreciate everybody on the team for bringing it all together, because all I did was run my mouth. All of you guys put it all together. You, Stephen, Gabby, Andrew, Shauna, Hannah. Hope I'm not leaving out anybody. And so thanks to Joe, and thanks to Mr. Burr, Devin Burr. So it was all good.
Awesome. Well, yeah. So folks, we've been putting all the links up, so as we wrap up for day number 2, as always, from myself, as you just heard from Brent, from, the rest of the team, Stephen and Gabby and Andrew and Joseph and Devin and Shauna, we thank you from the bottom of our hearts. Vivi, thanks you all very much. And we wanted to just, put it out there that if there's anything we can do to serve, there's the resources. We'll put up the links if anyone wants to set up a call to talk about a banking policy for yourself. We'll throw those links up, and you can just pick the most convenient time to meet with Stephen, Gabby, or Brent and do that. If you're already a policy holder and your policy is in force, we'll put the link up for Andrew so you can set up a mapping call, or get in with your map and kind of go over it if there's any updates. And then obviously, join us every Wednesday. They're free. The fact that everybody on here isn't on there is surprising, but it's 1 p.m. Eastern time every Wednesday. If you can't make it on Wednesday at 1, just register and we send you the recordings. Imagine that. And then you get to have cocktail hour with us at 4:30 every Wednesday for the Ask Me Anything happy half hour. We spend a half hour answering your questions. That's all we do. And we also have a cocktail or 2, sometimes 3. You never can tell what happens, but we have a good old time, and we want you guys to join us. And Stephen, in closing, can you also tell them about the next event that we have coming up?
Yeah, absolutely. So if you like the idea of, using your policy to invest, you just don't know, yet what to do. Do I want to get into real estate investing? Do I want to get into private lending? Do I want to invest in real estate through land or through flips or through buying rentals with the Burr strategy? Or do I just want to go out there and find deals and flip them to somebody before I even close on it, which is called wholesaling? Or do I want to just lend my money to other people or buy Airbnbs or et cetera, et cetera, et cetera, right? So Chris and I teach a very powerful 3-day virtual training class. The next one's coming up March 25th, 26th, and 27th. I believe it's a Friday, Saturday, Sunday. Chris and I bring in people from our network all across the country. We Zoom them in, and we teach probably 60% of the class, and we have multi-millionaire experts teach the other 40% of the class. And it's seriously one of the most powerful trainings I've ever been part of. And 26th, 27th, and 28th of March. And we charge a whopping $197 for it. So it's really awesome. You receive a bunch of extra tools, different documents that you need to do the business. We introduce you to Flipping Edge. I mean, we give you a free self-directed IRA, which is usually $350. We waive that for it. There's just so much. We get into LLCs, asset protection, tax liabilities, tax savings. I mean, we get into all this during the 3 days, and we bring it all together of how to use it along with your IBC, and we bring that into it too, your money multiplier IBC policy. So it's really powerful. So get part of that. Those of you that have been through it already and you're just looking at getting kind of handheld instruction on how to start lending your money out, becoming a private money lender, or you want to get into real estate investing, wholesaling, flipping, we have some group coaching programs coming up. I'll email you the details this week. If you want to be part of that, just email me. I'll send you an invitation, snaggy@chrisnaugle.com. I'll get you hooked up with that. And I just, one thing I wanted to address, we were talking a lot about the retirement accounts. There is a strategy where you can use your funds from your retirement account, your traditional IRA. You're going to pay taxes, but we have an insurance company that will pay you 20% above the money you're putting into your policy to help you with the tax liability. Get that money in there, and it guarantees you money being paid to you for the rest of your life at a certain point. So this is a new policy that we're doing. So reach out to us if you want to hear more about that. I know we didn't have a chance to really get into that, but it's something really cool. I just want to mention, because we do have people that are in their 60s that don't know what to do with these retirement accounts. And this is probably the best strategy I've seen so far on how to get that money out of that account, out of the stock market, and protect you where it can pay you income or your spouse for the rest of your life. Really cool new stuff we're doing. So like we said, like Brent said earlier, hop on the Wealth Wednesday webinars. This is where we talk about all these new strategies, all the new stuff that we're doing. So get on those webinars. Ask us your questions on the Ask Me Anythings on those Wednesdays also, and join us for the trainings. We'll invite you to the private Facebook groups, and let's just build this community, guys. It's been an awesome weekend. Thank you so much.
Absolutely. And that's what the training page looks like for the 3-day. There's all your speakers, and they just keep going on and on. They are rock stars. It's a phenomenal event. But folks, thank you all so very much for joining us for the last 2 days. This was an amazing event. And this was the first time we've ever done this, and it will not be the last. And you guys were the pioneers, the ones that spent these 2 days with us on this pioneer event. And I thank you all for that. So with that, we'll get these recordings downloaded. It takes a little bit. It's a lot bigger and a lot more work than we anticipated yesterday. But Shauna will get this out to you all. So you'll have both days trainings, and we'll see you on the next one. From us to you, have a good evening and a great Sunday. Thank you again.
Thanks, guys.